whether you need to have a main sort of a cheat sheet. I don't know if I told you this story. I had chemistry. I struggled horribly with chemistry in high school and college. And in the college one, professor actually said, here's the deal. You can put as much as you can fit on an 8.5 by 11 piece of paper and bring it to the final with you. And after my exhausting work at writing as small as I possibly could, everything I fit on the paper I knew. So it's that, right? It's just repetitions. Just pretend like that's the rule. Pretend like you get to make a cheat sheet for yourself and do it. And then that's the stuff you're going to learn the best, right? So make a sheet of T formulas or circle formulas. And sometimes they involve 3 or 4 steps, right? So you could draw it out into step 1, 2, 3. I do plan on making such a thing and maybe selling it to random strangers, but probably including it to the students that I teach in these types of courses. But it's not going to be as helpful as if you do it. When you make your own stuff, it sticks better. And I can attest to that. I'm a collector of courses and books. I have more courses and books than I could possibly get around to in all manner of subjects: guitar, music, obviously real estate and business. But I get it, and then I just kind of get on to the next thing and never really deep dive in it. So it's just that time to focus, right? You just really have to get into it and focus, and hopefully you've already figured out when the best time for you and your schedule works to study. And people leave you alone. That's probably the biggest challenge, is the people that have depended on you all this time need to kind of back off. And you've got to gear that up even more probably from here forward. This next month, what is it? Yeah, just about a month, not quite a month. The 12th is the final. So really buckle down, right? Double down. Now, in addition to covering the new material every week, you really should start going back to the beginning and reviewing, having a section of your study time for review and a section for what's current. So it's just sort of a constant moving process, moving target. We're going to get on into the rest of this finance because I think we did a decent review with our midterm exam review last night. We need to cover some territory. So the primary and secondary mortgage market. When we left last night, we had just started talking about this. The Federal Reserve System is that thing which is in place to hopefully keep our economy healthy, or when it does get off track, to get it back on track. And of course, everybody has opinions over what they should do and what decisions should be made. But the overarching goal is to keep things in check. When things get weird, like a lopsided housing market, how do we fix that? How do we, because that's not going to work forever and ever. And between that and world events, sometimes the Federal Reserve makes a choice to raise the interest rate. And it's an interest rate that they loan money to the banks that you and I deal with or work with. That's the interest rate they're raising and lowering. And then in turn, the interest rate that we can borrow with is affected. So that's it works sort of a downhill effect. Federal Reserve loans money to the banks that you and I deal with at a certain interest rate, and then they increase that interest rate for loaning money to us. So when the Fed raises the rate, it's affecting the rate at which we can borrow. And who knows? 6 months ago, everybody was just totally thinking that every couple of months, the rate's just going to keep going up and up and up. And everybody was counting down the days until we reached 10% for an interest rate to borrow for mortgages. And we didn't get there. We got to about 7. And then this last go around a couple of weeks ago, it dove. It went back down. So you can sit back and pontificate all you want, or you could get out there and just work with what you got, especially as brokers in this business. You just work with what you are faced with and keep your clients from jumping off buildings, theoretically, right? Keep your clients in check, keep them from worrying. And the potential clients, your clients are probably okay because they've actually made a choice to pursue and take action. It's the potential ones that are riding the bench on the sidelines that you need to keep a healthy conversation with, because that's prospecting. That's how you fill the pipeline for more business after the ones you're working with now are closed. You don't want to be in a point, and it's very common. You're going to be in this point, but you got to minimize this. But that point at which everything you had on the books to close has closed, and you have nothing else in the pipeline. Not a good place to be, but it's a very typical, common place to be, because it's so difficult to balance, especially as a single agent, new single agent, or any single agent, to balance the lead generation with the doing real estate, so that you get really good at figuring out how to get business and you get one on the hook, so to speak. And so you kind of let the lead generation habits that you formed fall away while you work with this one client, and your lead gen is going down, and then you get that client closed, and then you look around and you have not kept the pipeline full. It's just tough. It's hard. So you really need an education on how to fill the pipeline. And some people do that by buying leads. They're expensive. I'll just tell you that. Once upon a time, one of the most typical common lead generation websites, you could buy a decent lead for maybe $100. By the time you got it closed, what you would have actually spent per lead was about $100, maybe even less. But now they're telling me, because I've never bought those leads, by the way, but a lot of agents do. They made a career out of it. They did better than me, but they had to keep that machine, keep feeding that machine. I just didn't want to become a servant to the machine, right? But now it's like $400 for one lead that actually works out, and sifting through all the trash that's not really a lead, but they kind of passed it off to you. It's a whole other thing that we're not covering in this course, but that's probably the first thing you're going to learn once you get your license. You're going to have to, so you'll have somebody to do real estate for, right? Anyway, Federal Reserve is there to control the interest rate, set reserve funds. We talked about reserves. That's sort of the big problem from that they learned back in the Great Depression era, because the banks had loaned out all their money. They didn't have anything in reserve. So when people came and demanded to get their money out of the bank, it wasn't there for them to take. It was a combination of they loaned out too much of what they had, in this case, all of it, with the unlikely once in a million chance that everybody was going to want all of their deposits at the same time. That part they couldn't really control. But the first part they could fix, and that's why the Federal Reserve has set reserve funds, minimums that banks have to keep on hand. They've got to be at a certain level of liquid. They can't just loan out everything. That's what that's talking about. Okay, now we talked about the promissory note and how a common provision in the promissory note is that it is a negotiable instrument. Got to disclose to the borrower that the instrument, the promissory note itself, this legal instrument document, is negotiable, meaning you are giving me, the lender, permission to sell it to another lender. So therefore you, Mr. Borrower, might have to change to whom you send your house payment at some point, or maybe many times over the 30 years that you have this loan. So the market in which a lender is selling your note to someone else is called the secondary mortgage market. Think of it sort of as retail wholesale. So that secondary mortgage market is what funds the primary mortgage market. That might be a good thing to write down. Then we'll figure out what that means. The secondary mortgage market funds, F-U-N-D-S, the primary market, because I'm going to make loans to all of you, and you all have good credit. Therefore, you have. Why does that matter? Because that's the rating of risk. That's how much risk you have. The risk that there is that you might let your loan fall into default because you don't pay your bills. So higher credit means lower risk. And all of you have decent credit, good credit, therefore low risk. So I'm going to, as a lender, bundle all of your loans that I've made out to you into one big package deal. And I'm going to go sell it to Jason. Remember Jason, the director of the school? He's the other lender. I'm going to sell your big bundle package of loans to him. And whatever they're worth, I'm going to make some money on that sale. He's going to pay me so that I make a profit on that sale. Why does he want your loans? He wants your loans because his game plan is a little different. He has decided, look, I don't want an upfront chunk of money. I want to buy a bunch of loans that I can just collect interest on for the next 20 or 30 years. I want the long-term run. Because if you've ever looked at how much you end up paying for a mortgage, by the time you're finished paying 360 payments, it's like 3, 4, 5 times the amount you borrowed. So that's a lot more money. It's a lot of money. So he wants to buy it for the long-term interest earnings over time. Why do I want to sell them? Why don't I want the long-term? Because if I sell to him and he pays me and I get a profit, I'm going to take what I earned from that sale to him and I'm going to go make more loans to more people at more interest. And therefore, it is one big cycle. I bundle up, make a bunch of loans, and that's called the primary market, by the way. The primary market is when you go into Bank of America and say, I want to buy a house, and they say, okay, here's a loan we can do for you, and you close on that house. And you've made that loan with the bank. That's the primary market, the onesie twosies, right? One by one by one. And then all of those little single loans are bundled up and then bought and sold behind the scenes, sort of, from what the average consumer person would even know about. And that's the secondary market. So, primary mortgage market, it's where loans are originated. When a loan is made, it's called origination. Remember the origination fee from yesterday? That is the charge. That's one of the main upfront, in the moment ways the lender makes money. Over time, they're going to earn interest. But in the beginning, at closing, they make a chunk of money called an origination fee for originating the loan, making it, lending money to the consumer. What kinds of entities make these loans? Who has money available just to loan out to people? Well, commercial banks. Insurance companies have a ton of money. Who's paying insurance, whether car or motorcycle or health? Who thinks you're paying too much for insurance? Well, whatever you're paying for insurance, that insurance company is not just putting it in a savings account. They're investing it because they have certain actuary tables and statistics in place that tell them, okay, if I have this many policies, what are the chances I'm going to have to pay out on these policies? And they know what their risk is. Therefore, they feel confident to invest a certain amount of all that money they have on hand in the form of the premiums you pay them every month or however often. And they invest that. And what's a nice, safe, traditionally safe field to invest money in that's reasonably conservative, reasonably lower risk? Real estate. So they fund mortgages. Insurance companies fund mortgages, endowment funds, mortgage banks, mortgage brokers. What's the difference between a bank and a broker? Think of it this way. What are you studying to become right now? Once you get your license, you're going to be a real estate broker. Once you're a real estate broker and I have a listing that your client wants, can you make money selling them my listing? Give me a head shake in the windows, just in the Brady Bunch. Yeah. So you're safe and you're happy selling my stuff. And you're also happy selling them your own listing, aren't you? You're going to make money if you sell your own listing or mine. We're happy just selling each other's stuff. Well, that's brokerage, interacting with others. Mortgage brokers loan money from all sorts of different sources. So if you are a real estate broker and you have a buyer and that buyer doesn't know or hasn't talked about how they're going to fund this purchase they want you to help them with, that's the first question you should ask them. Have you talked to a lender yet? And if they have not, or even if they have, you say, well, I've got a great couple of suggestions for you, because you will. You need to have several good ones on hand that have proven not that they are the most popular, but that what I like, my number one criteria is a mortgage person who answers their phone. I don't want mortgage people that only work bank hours Monday through Friday, 9 to 5. There are a few. I once was working with one. It was the in-house mortgage person with the firm that I was at, and they just provided that as a service. But I tried to get an answer from him for a client of mine on a Saturday afternoon because we were hot and ready to find something and buy something. My client needed to know, had a question about a closing cost. How much are the closing costs going to be so that we can ask the seller to pay for them? We needed to know how much to ask the seller, how much was the most we could ask the seller to pay for the buyer's closing costs. He never answered. Come to find out, he was on his boat all day. Now, be on your boat. Fine. I'm not going to use you for mortgages, though. If you can't answer your phone while you're on your boat, I'm going to use the lady who can. I'm going to use the woman, the man, whomever, the mortgage person who answers my call when I need it. When do I work? What are my working hours? If it's a client who needs something, 24/7. Now, if it's a client who would like to talk to me just because, but it's not an emergency or not part of the process, I'm not answering 24/7. It'll be case by case, but for the most part, if we're closing in on getting something locked down, yeah, I'm making it happen. And I intend to work with people that also work that way. So a mortgage broker loans money or helps people, originates loans for people and uses investors from all sorts of resources. And another way to say it is this. You could go into Wells Fargo and say, I want a mortgage, and they could make a loan for you. And that would be called going to the mortgage bank. You go to the bank. So the bottom left, mortgage bank. Wells Fargo can do that loan, and they're going to charge fees for doing the loan. But then you could go to a random mortgage broker, someone that doesn't work just for one bank. They interact with lots of different sources of funds. They could probably do the loan using the Wells Fargo money, probably cheaper for fewer fees than Wells Fargo could. And I'm not just picking on them. I'm saying a mortgage broker usually has better options for cheaper than a mortgage bank, or they possibly could. It's worth shopping both. So tell your client that. Say, look, I know you've talked to Bank of America because that's who you have all your accounts with. You talk to them about a mortgage, but I've got a lady who does a wonderful job. She answers her phone. She's really hand in hand. She'll explain the process, and she's a mortgage broker. At least talk to her. She'll give you unbiased advice. Yes, she wants your business, but she mostly wants me to keep sending her business. Therefore, she's going to put your needs as a borrower person above her desire to make money on every single thing. It goes back to that relationship over transaction idea. So that's the difference between a broker and a banker. The broker has lots of potential places that they can fund loans. The banker is using their own bank money. Pension funds, like police and firefighter pension funds, investment groups, credit unions, all of these are just sources of money that is loaned out for the purpose of making mortgages because they have decisions to make. When they're managing big chunks of money, they're thinking, well, what can we do with this money besides bury it in the backyard? We need to do something with it so it earns interest, earns money. And so mortgages is a pretty popular place for them to park their money. Now, the secondary market is that going back and forth, lumping them together, selling them. And so we're buying loans from loan originators and in that process, putting the money back into the primary market, having more money available to loan out again. There are different marketplaces within which this buying and selling of loans takes place. Let me move around a little bit first. I think it would probably be more useful to tell you the types of loans involved. Then we'll come back and talk about the marketplace. So, categories of first mortgage loans. When you're talking to a client and they don't know anything, and they're saying, well, I'm a veteran. I heard VA loans are good because it's 100% loan to value, meaning zero down payment. A classic advantage of a VA loan is no money down. It's one of the zero down payment options, but you have to be either a spouse of or a military veteran or active. So your client says to you, well, I have that. I was thinking I would just do that. And you might say to them, well, how's your credit? Oh, it's great. I've always paid on time. It's like 800. Perfect credit. Okay. And how much were you planning? I know you said the VA loan is attractive because of the zero down payment, but if you could get a better overall loan and lower fees and a better interest rate because you put a higher, more down, anything down, would you? Well, yeah, I've got 100,000 to play with. I want to buy a $400,000 house. I have 100,000 more than that, but I have that available for the transaction. I could use that for down payment. Wow, your whole day just changed. If this person is answering this question now, this is your new best friend. You stick close to them until this deal is done, because it's unlikely, but it's all perfect. I'm setting it up for a reason. But what you would say to them is, okay, you're a veteran, so you could do VA. You have great credit and a lot you could use for down payment. Therefore, you could do FHA, but you don't need to. There's no reason to. The reason somebody would use an FHA loan, which we'll see in a moment, is because it's good for people that have a challenging credit score, not perfect score, or not very much for a down payment. So between the VA and the conventional loan option, that particular borrower should probably go with a conventional loan, even though they qualify for a VA loan. Because if it doesn't make any difference to them about putting in the down payment, their loan is going to be cheaper in terms of fees and interest rate being lower when they go conventional. What does all that mean? The reason is a conventional loan is a private loan. It is not insured or guaranteed by the government. The government does not step in. The government does step in for FHA and VA loans, as we'll see in a minute, but not for conventional. The conventional loan is going to be what you get when you have good credit and or something for down payment, a decent chunk of money to put down. Therefore, it's a lower risk loan because you have more skin in the game, more of your money in it to lose if you let it go to foreclosure. So therefore, you're less likely to let it go into foreclosure. So the lender likes that a lot. Lower loan to value ratio means less risk to the lender. What does that mean? Lower loan to value. Well, if you put zero money down, your loan to value ratio is 100. You're borrowing 100% of the sale price. If you put 20% down, your loan to value ratio is 80%. You're borrowing 80% of the sale price, and then you're putting your own 20% down payment. So a lower LTV means the 80 instead of the 100 in this case. The lender would like it better and is going to reward you with lower fees, lower rate if you put more money down. And that's why conventional loans are better also. You've got to meet various guidelines, meaning certain credit scores. Part of the process of applying for the loan and the loan approval includes giving the lender your pay stubs, last couple of months' pay stubs, proving what you make, and then also a couple of years of tax returns, also proving what you make and a little more of a detailed accounting for your financial situation. So those sorts of guidelines the lender wants. That's so conforming loans have to meet certain guidelines. Non-conforming loans means something that's a little outside of the norm. One type of a non-conforming loan is something for a lot more money than normal. If you're buying $1 million property, that's more than the average person borrows. Therefore, it's called a jumbo loan, and it has different kinds of guidelines that are not conforming. So either could be a conventional loan, but there's a conforming conventional loan and there's non-conforming conventional loans. So what's the best option if they can afford it and they have good enough credit for it? Conventional loan. If the borrower puts down at least 20%, that lender feels pretty confident that the borrower is going to pay it back. They're not going to want to risk losing that money. I'm writing something to show you here in a minute. So sales price there at the top, that full sales price, you're putting down 20%, you're borrowing 80%, therefore it's an 80% LTV, right? Well, anytime you put down less than 20, instead of 20, let's say you put down 10. Let's say instead of 20, you're only putting down 10. Well, now instead of an 80% LTV, that lender is loaning you 90%. Now they're nervous. They were okay when it was only 20% down and they were only loaning you 80%. But anything more than that they're loaning you, they're going to require you to do more to make them feel good and confident. And that is called an insurance policy known as private mortgage insurance. It's anytime you put less than 20% down payment. Oops, let me share that with you. There it is. Private mortgage insurance. Anytime you're putting less than 20% down on the purchase, the lender is going to require that you also pay for an insurance policy every month. PMI. Anybody heard of that acronym PMI? Private mortgage insurance. It is an insurance policy that is not for your benefit. It's for the lender's benefit. It's to make them feel more confident because you're putting less than they would prefer you put down. They want you to put 20, but they'll let you put less as long as you pay PMI. So it's additional security for that lender in case that you default as the borrower, and you pay for it. We're talking maybe $100 extra a month. In addition to the principal, interest, taxes, and insurance, if you put less than 20% down, you're also going to have PMI in that added to it. Of course, the lender, as we already think we know, hopefully you remember, is going to make the loan based on whether either the sale price or the appraised value. It'll still need to be appraised, and that appraisal needs to come in at sales price. If it doesn't, the lender is going to loan based on the appraised number, not the sale price. So if we're hoping that it appraises for sale price of $320,000, but it only appraises for $300,000, then the lender is going to make your loan based on the $300,000. Say you're going to put 10% down for a 90% LTV. 90% of what? Well, in this case, it's going to be 90% of 300, not 90% of 320, because it appraised lower. It's insured by whom? It's a private mortgage insurance company, and the lender will have them lined up. They'll say, well, PMI through this company, and you'll need to have a PMI insurance policy, and it'll be this much more per month in addition to the PITI. Now, the good news is for a conventional loan, that PMI extra payment for that policy doesn't last forever. It's temporary. How long does it last? As long as you only need to pay it as long as you don't have 20% equity in the property. But once you attain the point of having equity in the property, 20% or more, the PMI goes away. Currently, in real life, that PMI automatically goes away when your equity hits 22%. But for the test purposes, for the class purposes, you're eligible to remove it when it hits 20%. How do you know? How can your equity increase? Let's talk about that again. We talked about it before. So you start out this process with, let's say you put 10% down. So your equity in the very beginning is from your down payment. So down payment is the first way you get equity in a property. What's another way the longer you own it? As you own it over time, what are some other ways your equity in the property can increase? Good. Perfect. Appreciation. Yeah. Values go up. That's the best way. That's probably the big advantage of real estate in general, is through really no fault of your own, no credit to you except buying in a smart area maybe. Appreciation is happening, hopefully. So appreciation, your initial influx of down payment, appreciation. How about capital improvements? Meaning you spend your capital to improve the property. Things like porches, kitchen upgrades, sunrooms, anything that adds significant value to the property. Maybe you bought it and it only had 2 bathrooms, but you have upgraded it and now it has 4. Maybe it had a carport and you just threw a garage door on the end and now it's a garage. You can call it a garage. That adds more value for what? The cost of a door and maybe a little bit of framing. $1,000 and now you've got the credit for a garage instead of a carport. All that sort of thing adds to your equity. So you've owned it for 5 years. You put a garage on. You converted the carport to a garage, or even better, you converted the carport into heated living area. That adds even more value. So you've done capital improvements. It's appreciated because it was in the last 3 years, and you had a pretty decent down payment of 10%. So today, fast forward 5 years from back when you bought it, and you paid $320, and now it's worth $370, possibly. So what amount of that $370 is your money versus what you owe? Well, let's say you borrowed $290. Well, let's see. How would that be? You paid $320. You put 10% down. That was $32,000. So your loan amount, I should have just done this, was originally $288. Over 5 years, you've made regular payments, and let's say you get that loan amount. I have no idea, pulling from air. Let's say you get it down to $281. And now the value is $370. Now instead of $32,000, you've got $89,000 in equity in that property. So have you hit 20%? If we did the math, we could discover that pretty easily. So if you think you've hit 20% equity in the property, you would tell your lender, look, it's been 8-10 years and I've done this and that and the other. They'd probably say, well, you can apply and for having your PMI removed. They're probably going to require that you pay for an appraisal, probably $500-$600, so they can get a third-party opinion of what the value is right now. And if they find that your equity has gone up to the 20% or more, you no longer have to pay PMI. Might be $100, $150 a month that you're saving. That's how PMI works. So it's removed. It's only temporary. It's removed when that LTV requirement is met. What requirement? 80% or less. So that's PMI and a conventional loan. Conventional are cheaper. They're better, but they require better credit and more down payment. FHA loans are now, the government is insuring them. The government wants people to own property. The government says, let's help people that otherwise couldn't afford a house. So this way, if we step in and insure the loan, insure it from what? From chances of default, because an FHA loan allows for lower credit and lower down payment. The two things that lenders are worried about. Lenders are worried that because you have lower credit, because you're putting less down than 20%, that you're more likely to default. Well, the government says we will insure against that default. We will put in place an insurance policy. Guess what it's called? Mortgage insurance premium. Oh, wait, that sounds a lot like this one. It's a lot like this one. It's pretty much this. PMI on a conventional loan is pretty much the same as MIP on an FHA loan. It's accomplishing the same goal. But the big difference is it never goes away. So if you can get either a conventional loan or an FHA loan, and the payments are going to be roughly the same, but on the conventional loan, your PMI is another $100 a month, and also the same on the FHA. But when you hit 20% equity or more on the conventional, you don't have to pay that PMI anymore. If you have an FHA loan and you hit that 20%, it doesn't matter. You still pay that MIP, mortgage insurance premium. It doesn't go away. it's going to be there for the life of the loan, or if you refinance into a conventional loan, you could get rid of it that way. So that's the big kicker about the difference in mortgage insurance between these two. Now, the FHA does not originate the loans. They don't make the loans. They just stand behind them. They insure them. They don't make loans. They don't originate loans. You go to the same lender for an FHA as you would for a conventional. Not all lenders do the same kinds of loans, but some do. Some do FHA, conventional, VA, and so it's the same kind of process. You'd go to the same sorts of places, mortgage brokers, mortgage bankers. The lender is still the one who makes the loan itself, originates it. The lender is also the one who sets the interest rate, not FHA. And the lender is the one who you have to seek approval from to get the loan, not FHA. All FHA is doing is stepping in and saying, look, if they don't pay, we will insure the property. Insure so that now this FHA loan can be considered less risk because you've got the government kind of standing behind it because of this MIP program. Borrower still pays it. They're paying the MIP. So the positives for an FHA loan, why a borrower might choose the FHA loan, is because they don't have as much for down payment. The lowest down payment FHA loan, they let you go down to as little as 3.5% down payment. Quite frequently, conventional loans, there's more products. It depends on different banks and brokers, but for the most part, it's not uncommon for a conventional loan to be at 5% or 10%, or of course 20 or more. But as low as 5%, there might be some certain programs to help certain categories of buyers, maybe first-time buyers, maybe police, maybe teachers. But for the most part, a conventional is going to get as low as 5%, allow as little as 5% down. FHA will allow as little as 3.5% down. It hasn't always been that way. When I got in the business, it was as little as 3% down for FHA, but they changed it a few years ago. So if a borrower only has limited funds for down payment, this is the way to go. And then also if a borrower does not have a certain level of credit, then FHA would be their only option compared to conventional. They can't qualify for a conventional loan because they don't have high enough credit score. Or they have more monthly expenses than a conventional lender will allow. Remember the qualifying ratios, 28-36 for conventional loan. You can't make more than, or you can't spend more than 28% of your gross income on the PITI, and no more than 36% of PITI plus recurring expenses. Well, when it's an FHA loan, those qualifying ratios are higher. 28-36 on conventional is it's 43 on the back end ratio for FHA. So if you have that situation because of student debt, medical debt, reasonable car payment, not even a crazy one that you have to have a car because you got to get to your job, there's really no good reason to get rid of the car payment. Therefore, FHA might be the way to go because it allows for that higher debt to income ratio. And an FHA loan, if you recall, when we talked about the provisions in a promissory note, no prepayment penalty allowed. Can't charge one. So that's nice. But the big negative for FHA compared to conventional is you'll never get rid of the MIP while you have that FHA loan. Never goes away. So both of those types of loans are available to anybody that qualifies. But this next kind of loan is only available to military and spouses of military. So therefore, military and spouses of military and anybody else can do FHA and can do conventional. But they can also do this one. And the big draw for a VA loan is that they will allow no money down. Now, just like the FHA will insure the loan, the VA will guarantee the loan. The VA stands for Veterans Affairs. And that's a testable question they like to ask. Don't fall for the trick. Don't let them tell you something like this. An FHA loan is insured by the government, guaranteed by the government, unaffiliated with the government, or stands for Fair Housing Act. Well, it does stand for Fair Housing Act, but we're talking about loans. So don't fall for the guaranteed. FHA loans are insured by the government. VA loans are guaranteed by the government. But it's very similar in that, again, the lender's the one who makes the loan, the lender's the one who sets the rate, and the lender's the one who you have to get approval from. But the VA says we will guarantee this loan. Guarantee from what? And insure it from what? From default. Saying, look, we'll step in if they default. Now, we just said that the VA will not make the loan, but there is an exception in this case. If that veteran wants to get a house or a property in a rural area that no bank is willing to loan money on because of how far out it is, perhaps, then the VA might be willing to make a direct loan, originate a loan in a rural area if no lenders are willing to do it. Again, the point of an FHA and a VA loan is to help borrowers who otherwise wouldn't have a chance at ownership. So with that in mind, that kind of puts it all in perspective. They're trying to set borrowers up for successful home ownership. Therefore, do you think an FHA appraisal is going to be more strict than a conventional appraisal? You bet. When you are taking a listing and you're talking to somebody, and let's say it's a price point that's $200,000 to $300,000, which is bread and butter for a FHA loan. Somebody who's trying to get a home using FHA money, probably wouldn't be unheard of that they're buying in a price point that's below $300,000 or $400,000. And you're going to open your seller up for more potential offers in front of more potential buyers if it's going to also be appealing to a buyer using an FHA loan. Therefore, what is it going to take to sell this house to an FHA buyer? Well, you're going to need a good roof, because an FHA appraiser is not going to let an FHA buyer have a house that's going to need a new roof next year, next 2 years. They're going to write it on the appraisal report and say, oh, this roof is near the end of its life. This seller is going to have to replace it. Does that seller have to replace it? No. But what's the alternative? This buyer goes away, right? This buyer walks away. Seller chooses not to replace the roof. Therefore, save the time. If your seller doesn't want to fix a roof or replace a roof, just tell everybody, look, this house is not for FHA buyers. We're not going to entertain offers that are using FHA financing, because we don't want to have to worry about a stricter appraisal, because we know the roof is old. It's 25 years old. Most roofs last 25 to 30 years at best. Or another FHA provision for the appraisal is that it has to have a working range oven, right? It's got to work. Some houses are foreclosures or trashed, and the person took the range with them. There's no oven in the house. Somebody needs to put a range in there if you want to make that house available for FHA financing, because that's required for the appraisal for FHA. So these FHA and VA loans are going to be a stricter appraisal process, because we're trying to set these borrowers up for success. Now, what are the positives for VA? Low down payment, nothing. You can roll the cost into the loan so that the borrower can come in there, sign papers, and walk out with keys and not put any money in. VA loans, they are allowed to prepay, no prepayment penalty. They are assumable. The VA would have to approve that assumption, but if you want to sell a house that you own using a VA loan, you could let that potential buyer assume your VA loan. They would need to qualify for it. Can't be a non-qualifying assumable. They'd have to prove that they can afford it. Here's the downside of letting somebody assume your VA loan. You, as a veteran, only have entitlement to one VA loan at a time. So if you let somebody assume yours, you've tied you've tied up your VA entitlement. You can't go out and buy another house with your VA ability because it's tied up in this house that you let someone assume your VA loan on. They would need to, maybe you let them do that for a while because you're just going to go rent. But eventually they refinance into a conventional loan once they get their stuff fixed and taken care of. Then you would have your entitlement back. Now you can borrow your full allowable amount using VA financing. Yeah, sure. Like a yeah, you'd have to refinance or something so that you could free up your eligibility. Okay, thank you. Good question. And more than you need for this class, and I don't have that off the top of my head, but I could probably point you in the right direction to get those kinds of questions answered as a consumer. I can give you a resource like an actual lender who does and knows VA loans really well. Yeah, sure thing. What are the downsides for a VA loan? Well, something called funding fees have to be paid. The origination fee is paid at closing, and again, you can only have one VA loan at a time. Here's some additional words to know about the VA loans. Instead of an appraisal, what the VA appraisers are doing is figuring out they're creating what's called a certificate of reasonable value, or CRV. When you see certificate of reasonable value, just think VA appraisal. They're determining, is it worth it, so that the VA can feel confident and the lender can feel confident loaning the money. Your entitlement, how much you're allowed to borrow, is determined by how you were discharged and how long you served. More for the best of those two categories, of course. And then the first step you take when you want to seek a VA loan is you check on your certificate of eligibility. You probably just go online. Used to be you'd have to go to Winston-Salem, but you can go online, get your certificate of eligibility. It's the maximum amount you're guaranteed to be able to borrow. Just some vocabulary associated with VA loans. That's about the level that they're going to test you at. You don't only have to be a veteran to have a chance at a no money down loan. There's other zero down type loans, and this is one of them. A USDA loan, another government loan, right? It's guaranteed by the USDA. It's a direct loan from USDA. It's only for households, families that hit a certain minimum, low to medium income limit. Can't make a bunch of money and get a USDA loan, is to help people who otherwise couldn't afford a house. You can put as little as zero down. The USDA will subsidize the interest rates so that the borrower can afford them. But the problem with the USDA loan is the money can run out. A certain amount is allotted for these loans, and if a bunch of people maybe later in the year from when the allotment was put forward, if a whole bunch of people have used it, they could have used all of it up. And so your client might want to try to get USDA loan, and it might be perfect for them, but they find out, sorry, no more funds available. It's all dried up for this year. So direct loan from the USA is for low to moderate income limits. Not sure what those are. They change from time to time. Any question about loans that you get when you're out on the street, out in the wild, it's good to know as much as you can know about this stuff, but just like law advice, you would never give them loan advice. You're going to want to say, look, well, here's what's possible, but for your specific situation, let me put you in touch with a good lender, because they know the day-to-day, most current information. And what you really want to know is how it applies to you specifically, not just to people in general. Therefore, here's a name and number. right? Lots of different kinds of loans out there. A purchase money loan, that's another kind of seller financing. We saw an installment land contract. That's a type of seller financing. Well, so is a purchase money mortgage. Purchase money mortgage, think the seller is the bank. A bridge loan is letting you make the leap from the house that you still own to the one you want to buy. You're getting a loan to help you because you hadn't sold the one you own right now yet. You're trying to get over to the new one. So a bridge loan helps you bridge that gap short term. Other things, a buy down. A buy down goes back to the discount points. You can buy your rate down temporarily. So if you see anybody heard of a 2-1 buy down or a 3-2-1 buy down, they're more common. They're in the news. People are talking about them a lot right now. Again, to help alleviate the stress people are feeling because the rates have gone up so quickly, so much in such a short time. So a 3-2-1 buy down would mean that for the whole first year you own the property, you're going to enjoy a certain interest rate lower than the market rate. So maybe like this, 3-2-1 for the first year, your rate's going to be at 5%. For the second year, it's going to be at 5.5%. And for the third year and beyond, it's going to be at 6%. You're buying down, you're paying a chunk of money in the form of some number of discount points in order to buy that rate down. And it's just going to step up over time. It's a way to help people who feel like a good example might be a doctor who's in residency and they feel like my income this year is going to be dramatically different than it will be in 3 years or next year. Or if some reason you feel like you're going to be in better spot next year than this year, go ahead and get the house. Have a payment based on a lower rate now, and it gets up over time. A reverse mortgage is something that appeals to people that have more equity in their property. A lot of times that type of person is a retiree because they've owned the house so long, they've paid their loan off, and they have 100% equity. There is no loan. Well, what's the other thing about a retiree? They're retired, right? And hopefully they have money coming in from retirement, but maybe they don't. Maybe they need more. Quite often people need more than they've planned for. So a reverse mortgage lets them be the one who receives the payment. A normal mortgage, you're making a payment to the bank. With a reverse mortgage, the bank's making a payment to you. Why would they do that? Because with every payment to you, your equity in your property comes down. You're giving up your equity in the form of those payments to you. So that because you're on a fixed income, you need it. It's for a special situation. And there's going to be, obviously, just like there's a maximum limited amount of equity that you have in your property, there's going to be a limited amount of time that you can be receiving these payments. And it's kind of a sad thing to really think about. How much time do I have left on this earth that I need these payments? Am I going to outlive the equity in the house? But it might be a good solution for at least a while. And if you're fortunate enough to live longer than the house has equity, you're going to need to figure something else out, right? So reverse mortgage, it's also a way, historically, there have been predatory lenders that have used reverse mortgages and people have suffered from them. So just have to be real careful. Sometimes you might go on a listing appointment and you find out, oh, there's a reverse mortgage here. This means that you're not going to have any proceeds when we sell it. You're going to have to pay off and pay back that lender, right? Because now you have all this loan balance because you've already taken out the equity in the form of the reverse mortgage for these last several years where you've been receiving payments to keep your bills paid. A package loan is something that puts together real and personal property. Maybe if you buy a new construction model home and it's got personal furniture in there too, you buy the whole thing, it finances all of it together. A blanket loan is something a developer would get for the whole community, and then they sell you a house so that blanket loan is decreased by that one property's worth. So they get to carve off each property as they sell it from the blanket loan. A construction loan is another short-term solution when you want to build a house. You want to build a house, you can borrow, set up this construction loan so that you need to take out $30,000 so that you can dig for the footings and the foundation and do all that part of the phases of the work. So you get that, you pay it to the professionals, they do the work. Somebody comes out and makes sure the work was done, the money was really spent for that. They approve you to get the next chunk of money, the next draw from the construction loan. So now you can put on the floor and the framing. And now you can put on the electrical and the plumbing and the sheetrock and the insulation and then the sheetrock and then the roof, whatever order it goes in. They give you draws from this construction loan, and you pay the interest on whatever you have taken out so far. And then once the house is complete and they've issued you a certificate of occupancy, meaning now you can own it and live in it safely, you'll convert that construction loan into a normal type of mortgage, typical 20, 30-year mortgage. And then a home equity loan is a form of a second mortgage. If you have a home already with a mortgage on it, and let's say it's worth $300,000, but your loan is only for $100,000, well, how much equity do you have? $200,000. A bank will give you what's called a home equity line of credit. Not against the full $200,000 though. They're probably going to maybe give it to you max 80% of the equity you have in the house. They need to have a little cushion. They're not going to let you push the limit there. And then with that home equity line of credit, another way you might have seen it referred is a HELOC, HELOC. It's basically a debit card. You swipe that card and your equity is coming down. It's a good interest rate. It's usually a pretty low interest rate. It might be a good way to not only improve the house, but spend it on some emergency things that might pop up, or so you lose a job and you have a HELOC. Once you get it approved and you have the card, you can spend it for other things. The downside, the dangerous thing is that people spend it on frivolous things, vacations, things that don't really add value or aren't like a necessity. It's a good emergency solution, but it can be abused and people can get in trouble, and then they have an extra loan balance to pay off when they sell the house. So as a broker, why does this matter? You need to ask them, do you have a loan on this house? Yes. Do you have a second mortgage, like a home equity line of credit? No, I don't think so. And then later they say, oh yeah, I forgot. We have that we pay $150 a month toward it. Or they may have never borrowed against it, or they may have borrowed against it and paid it off, and they still have $20,000 available to borrow if they want, but it's just sitting there unused. It's just good to know how much they owe on any mortgages they have against this property, so you can tell them how much they're going to get when they close. No fun to tell them they're going to get $80,000, and because of the HELOC nobody mentioned, they're really only going to get $40,000 because maybe they need the 80 to buy the next thing you're helping them with. Let's go ahead and take our break and we'll just keep marching on. I'll see you in 10. join me. We'll talk about this vocabulary word, subordination. It has to do with the priority of mortgages. A lower priority lien is being moved ahead of a higher priority lien. That higher one is subordinating itself. So they're put in line based on when they were recorded, but that first mortgage will be first in line in case of a default. They get paid first. The second mortgage, of course, in the second place. To subordinate a loan would be to swap them for various reasons. What is the process of getting a loan? Well, you apply for the loan, right, with a loan originator. That's that first person. That's that one that you as a real estate broker is referring to people. Lots of different loan originators out there, a loan representative. That's the first contact. That originator is going to ask for some documentation. Check stubs, bank statements, tax returns, and they're going to, and of course the application itself, they're going to have the applicant, the borrower, sign the application, which says things like, I make this much, I owe this much, and I want to buy this, and here's my name and address and all that good stuff. They collect all that information and they put it together and pass it off to the loan processor. The loan processor then goes about verifying these things. They'll actually reach out to these various places and make sure that all of this stuff is on the up and up, and they will get the most recent credit report and all this stuff to make this loan package as nice and tidy and easy for the ultimate person in the line, called the loan underwriter, to make a decision. That's the person who decides if you get the loan or not. So the originator is the first one your borrower meets. They pass it on to the processor, and the processor is not really somebody your borrower is probably going to meet face to face. They will possibly email them, ask them for more information or maybe a more recent pay stub. And then that processor's job is just to fill in check marks on the screen. Do I have this? Did I get this from them? Did I get this and this and this and this? Oh, the appraisal came in. Great. Add it to the list. They put that all together in a nice electronic gift, a nice bow on top, and they submit that all together to the underwriter so that they can go down through all of the other loans and they can say, yep, okay, they've got this. It looks good. Okay, yes, I'm going to give it the go-ahead. Underwriter says we have conditional loan approval. So what is looked at? What do we look at when during this underwriting process, this approval process? Obviously, credit history and credit score. They're going to pull credit scores and credit reports from the various reporting agencies. They're going to verify that their income is adequate for the house that they want, for the payment, for the price. They're going to see what the expenses are. Are there HOA dues? What's the insurance? Does all of that make a difference in their affordability? Did they buy so much house in terms of can they even afford anything more than the house payment? And then, of course, recurring obligations, car payments, other recurring debt. Property analysis would be the appraisal, and then title investigation. That lender wants to know if it's a clear title. The attorney's the one doing the title search, but the lender cares that that title is verified, that we're buying it from the actual seller who has the right to sell it, and that it is a nice clear title, no clouds, no color of title. That lender obviously is making a loan with an interest rate on the line. And interest rates change. They fluctuate, even within the day. So a rate locking that rate. This lender's going to authorize a rate to this borrower, and okay, we will give you the loan at 6%. But that rate is only locked for a certain number of days. They'll give you like a 30-day rate lock. What happens if you think you're going to close in 30 days? Your rate is locked for 30 days, but something happens and there's a delay. And now you can't close in 30 days. You're going to have to close. It's going to be another week. Well, the contract allows you to close up to 7 days past the original agreed upon date, but there are other issues involved. One thing as a buyer agent you want to check with the lender and say, oh, we're not closing on time. We're going to have to bump it a whole week. Are we okay on the rate lock? And the lender might say, no, the rate lock expires today or the day of closing. Therefore, if you go past that, somebody's going to have to pay for a rate lock extension to honor that rate because they changed. If we don't get a rate lock extension honoring the 6%, it's going to be adjusted up to the 6.5% that it went to. And who's paying for it? Anybody can pay for it. Sometimes an agent will pay for it. Sometimes the seller, if it was their fault for the delay. But many times the buyer and their lender is the reason for the delay. Therefore, the buy side or somebody on that side is going to pay for it. So a rate lock just holds that interest rate at the current market rate so that you know what you're going to have. So like I have a buyer now who's building a house, going to take 8 months. They're not going to lock in their rate yet because they'd have to pay a lot for 8 months worth of a rate lock. They're just going to wait until closer to closing time. It's not even going to matter for them until then. And then, of course, they're going to have to make a decision. And if it's within 30 days or maybe even 60 days, they're going to have to think, what has been going on in the mortgage market with the interest rates? Have they been staying pretty steady or have they been pretty volatile? Have they been going up and down? And they might want to gamble and say, I really just think based on my vast knowledge, this is them talking, that they're going to be higher when this house is finally closed. So therefore, let's lock in today's rate because I think it's going to be worse later. Or they might say the opposite. I think I'm going to roll the dice. It's where it's 7% now. I think it's going to probably go down later. So let's just wait and lock it in later because I think it's going to be back down. You stay out of it as a broker. You certainly would not guarantee or make any promises. You don't know. None of us know. You just have to, and really it's more between them and the lender anyway. They're going to talk to the loan originator about the rate and when it's time to lock it in. That's kind of not your area of expertise anyway. As a real estate broker, you want to work with buyers who are both serious and able. Serious about buying and able to buy and actually make offers that are supported by a pre-approval. But a pre-approval is different than a pre-qualification. In real life, in the real world, if they say I've got a pre-qualification letter, that's not as good as a pre-approval letter. Pre-qualification usually means that the lender asked them some questions about their income and they gave them some answers and nothing was verified. So it's all based on their verbal responses. Yeah, from what they tell me, should be good. You're probably safe to go show them houses in this price range. No, I don't want to show houses with a pre-approval. I want them more invested in the process. And if they won't get a pre-approval and they insist on just the pre-qualification, that's what I meant to say, then you have to really think about their seriousness. And do you want to risk wasting your time? Sometimes you do. Sometimes it's like, okay, it's just because it's their personality and I feel like they are really serious. But best bet, and really you can blame it on the market. You can say, look, guys, we're not after a pre-qualification letter from the lender. We want a pre-approval letter because in this market, how fast it moves, we need to be ready to make an offer. And I don't want to have to stop everything and not be able to make an offer because we don't have a pre-approval letter in hand. We need one in our hands ready to go. And that's a pretty easy sell to convince them. They need to go ahead and talk to a lender. Sometimes people will say, oh, I just want to go look at some houses. I don't want to talk about the financing yet. I know I can afford it. And again, business decision. They might feel they can afford it, but what are they basing that on? Their cousin that told them what they can afford? People lie. People say how much they got the house for what kind of a deal and how much they make for a living. You really just need to push hard within reason to get them to talk to a lender. And I'll just say things like, look, guys, everybody's situation is different. In order to have the best chance of success for buying that perfect house for you, You need to have all your ducks in a row. Here's a great person to talk to. They won't give you a sales pitch. They won't try to pressure you. They'll just give you answers so you'll know what you can afford. The next thing I tell them is this. Every lender is trained to think in terms of the maximum house you qualify for. But I don't care about that number. I don't want you to buy the maximum house you qualify for. I want you to take that number from them. You maximum qualify for 500, but maybe you need to put 2 kids through private school. Maybe it's a religious school. Maybe you also want to have a certain level of lifestyle. You have a boat dock, a boat you keep docked somewhere, and that's just what you do. Or maybe you're saving for college educations, and you have a certain amount. For whatever reason, the payment on 500 is more than you want to spend. Maybe we need to be looking in the 350 range for the house because you need an extra amount of money per month to put toward whatever that's none of my business, that is about your choices. And that's the number I'm interested in. I don't want you to become house poor. And once you go into that explanation, I think you win them over. They realize, okay, this is not a person just trying to sell me the most they can squeeze out and get as much commission as possible. This is a person who wants to look out for my needs first and foremost. So, pre-approval. That way they can actually act and make offers, because in this kind of market, sellers probably won't even consider offers that do not have a pre-approval letter from a lender included. So they should get pre-approved. And here's a testable item. When has loan application been made? Officially, loan application has been made. They've applied for the loan when the lender receives the address of the property. So when has the loan been applied for? The point at which they've said it's for, I'm applying for a loan to buy this house. Here's the address. When the address has been given to the lender, that's the point at which loan application has occurred. The other thing is, just like anything, if anybody's ever not received credit, maybe you applied for a Best Buy card or a car loan and you didn't get that approval, as you well know, the law says you have to get denied in writing. So they already told you, and then like a week later, you get this letter in the mail. It's like insult to injury. Oh yeah, I remember that I failed to get that approval last week. They have to give you that loan denial in writing. There are some laws in place to keep lenders from being predatory, because lenders were a lot of bad lenders, just like a lot of bad anybody. But lenders are kept in check with the Truth in Lending Act. Truth in lending sounds like what it is. You have to tell the truth in your lending practices. The Truth in Lending Act says, tell the borrower what they're really paying for and what all the fees are. Don't surprise them with fees halfway through the transaction, because you know that they're already too invested to go anywhere else. That happened a lot once upon a time. But now lenders have to tell borrowers, this is what you're going to be looking at in terms of fees for this loan, and then follow it up at the closing within 3 days, no less than 3 days before closing, and prove that, yes, we honored our promise. This is indeed what you're being charged for this loan. So, a couple things under Truth in Lending. RESPA is another acronym. It stands for Real Estate Settlement Procedures Act. Settlement procedures, the closing, the settlement. What are the procedures required when you have a closing, a real estate settlement? There are some abusive practices that RESPA was designed to discourage. So we're going to learn about some different RESPA violations. And lenders can be guilty of RESPA violations, but so can brokers. We as brokers could violate RESPA if we get paid from another party without telling our client, for instance. Regulation Z under RESPA within the Truth in Lending Act says any fees associated with the loan have to be disclosed to the borrower. In other words, the lender has to tell the borrower, here is everything you're going to have to pay. Before 2008, for instance, there were it was possible for different lenders to show borrowers what their fees were with different formats of a good faith estimate. They'd give them a good faith estimate, they would call it, but there was no regulation involved. They might hide some fees. What kinds of fee could they hide? To if they promise, like if the rates are at 6%, and this one lender sounds really good because they promise a 4.5% rate, what's a thing they could be kind of hiding from that borrower that gives them the ability to give such a low rate? If everybody else is charging 6 and this lender's charging 4.5, how could they do that we've already talked about yesterday? You got it. In the fine print, they hide the fact that you need 45 discount points. Maybe not that many. But what your first question is when you see, or when your client comes to you and says, oh my gosh, this other lender I found, maybe it's an online lender, has such a lower rate than everybody else, your first thought is, okay, how many points for that rate? And then you ask them, you say, well, let's look at it. Where's the loan estimate? Did they give you a loan estimate? Did they show you the fine print? And then you inevitably find out, yep, this rate is only possible because you have to buy 3 discount points. Good to know. And it kind of shows you, lets you show off as a knowledgeable professional to catch such a thing. Well, Regulation Z requires the lender be very transparent when it comes to that sort of thing. Regulation Z also affects we as brokers in our advertising. It says, what's a really if you needed to sell something, if you needed to sell a car, what are some ways that you would probably get a buyer's attention if you're a car dealer? Obviously the car itself, pictures of the car, maybe a warranty on the car, but what do you see in car ads all the time that really gets you thinking, makes you stop and read that ad because you're like, I could own that really nice car for what? It's not the price. It's what? Yeah, low down payment, but also the low monthly payment. Maybe they don't even hardly tell you the price. You have to read the fine print, but they grab you because you're like $250 a month car payment. Wow, I could have that kind of car for only $200 a month. Well, that's also a great way to advertise property for sale. It's good to make people think not in terms of the price, especially now, but in terms of what that means per month. So it's not a terrible idea to say you could have this house, my listing is for sale and it's available. You could actually possibly own it for $1,250 a month. That is not a bad way to advertise a property, but RESPA steps in and says, if you advertise anything about a payment, you have to show full disclosure. You can't just advertise the payment without telling them how many payments, what the loan amount is, what the interest rate is. It's like 4 or 5 things we'll see here in a minute. And those things are called trigger terms. So we as brokers can advertise things related to the loan, but we have to disclose everything, not only just one of these things in italics. If we advertise the rate, we have to advertise the other stuff. If we advertise the payment, we have to advertise all these things along with it. It doesn't have to be equal font size, but it's got to be in the ad. So a rate needs to include the finance charges and the number of payments and how many payments and the amount financed. So just advertising a payment is not enough. That triggers the requirement to advertise the rest. How is that payment possible? It's possible with these other things. So anytime it's a specific number related to the loan, you've got to disclose all the credit terms. It's all or nothing. These are trigger terms. So here's the testable question. Can a real estate broker advertise their listing using trigger terms? Yes or no? Can a broker advertise their listing using a trigger term? Yes or no? We have some more answers here. What do we think? Can a real estate broker advertise trigger terms? How about this? In what way can a real estate broker advertise a trigger term? You can unmute. Only if you advertise the rest of it too. So the short answer for the first question is yes, you can advertise trigger terms. Yes, you can, but only if you include all of this other stuff. You've got to tell them, you can tell them the payment or the rate, but you've got to tell them these other things too: the charges, the number of payments, the amount, the total financed. Any of these are trigger terms that require the other items here to also be disclosed. So if you advertise one of these things, you got to include the rest. So yes, you can use trigger terms, but it requires that you use the other terms along with them. Does that make sense? Couple things though, testable stuff. While you got to watch out for trigger terms, and yes, you can use them, but again, you have to use all of them. If you're going to use any one of them, you got to use the rest. There are some things that are not actually trigger terms that don't require the full disclosure of everything else. If they just say that a seller's paying closing costs, well, that's not a trigger term. Closing costs paid is not in this list. We're talking about interest rates, amount financed, and how much the payment is. Those are the trigger terms. What are not trigger terms? The fact that the seller's paying for HOA dues, maybe the builder's paying for your credit report fee, maybe the seller's paying your closing costs. These are not trigger terms. This is easy stuff to get right and wrong. You just got to pay attention. So what is not a trigger term? These things. These are not. Trigger terms involve the payment. What's involved with a payment calculation? The interest rate, the loan balance, number of payments, the amount of payment, that sort of thing. Those types of things are trigger terms. These items here do not affect the payment directly. So therefore, they are not considered trigger terms by RESPA. You can advertise any of these things without having to advertise all that stuff back here. You can also advertise in broad strokes. As long as you don't get too specific, you're okay too. These are not trigger terms either. You can say no down payment on this house, low down payment, no payments, low payments, something like that are not trigger terms. The Fair Credit Reporting Act is in place to protect consumers. It sets standards so that the Equifax, TransUnion, and Experian, I believe, they have certain standards, sets reporting standards, establishes consumers' rights to see their credit report. You can get one free credit report per year, from the different agencies, and correct errors. You can, I'm sure it's no fun, but you can. There is a process you can go through to get mistakes on your credit fixed, repaired. And then retention of records. The Fair Credit Reporting Act says that even negative information can't be there forever. Most of your average negative information is going to be on your credit report for at least 7 years. But bankruptcy and foreclosure, pretty serious ones, they're going to be on there for at least 10 years, right? So the Fair Credit Reporting Act addresses these things. It says what's going to be on that credit report, what's allowable. We haven't talked about much in the line of fair housing. We know that there's some fair housing categories. I think we've talked about the Fresh Corn acronym. Can't discriminate against people on the basis of race, religion, color, national origin, familial status, like that. There are some additional protected classes when it comes to lending practices. 3 classes that fall under this Equal Credit Opportunity Act include age. Can't discriminate on somebody. If you're a lender trying to decide if you're going to loan money to them, you can't deny the loan based on their age or their marital status, married versus single, or whether they're receiving public assistance income. But think about the age one. I've got a friend whose grandmother lived till she was 105. When she was 104, she was still getting around pretty well. She could have gone into a bank, said, I want a 30-year mortgage, and it would have been illegal for that bank to deny her that mortgage because of her age. Even though everybody knows the chances of her living to 135 to pay off this 30-year mortgage may be a little low. Doesn't matter. Equal Credit Opportunity Act can't discriminate, can't deny a loan based on age or marital status, or that the lender can't say, oh, you get assistance, you get public assistance income, then I'm not giving you a loan. That's also illegal. As a broker, you might hear stories about these things happening. So you need to know who to turn people into in that case. We had skipped something because I wanted to tell you about conventional and FHA and VA. So let's go back and talk about that secondary mortgage market again. So now we know the types of home loans: conventional, VA, FHA. The marketplace in which those loans are packaged up and sold back and forth. There's three main ones. Fannie Mae stands for Federal National Mortgage Association. You'll just see it if you write the acronym for it. FNMA just kind of looks like Fannie Mae, so you'll hear it referred to as Fannie Mae. It's the biggest one. We're going to see it here in just a second. The one for government loans, like FHA, VA type loans, government-backed loans, is called Ginnie Mae, Government National Mortgage Association. And then some other kinds of loans, like savings and loans and bonds, that are loans that are made based off of bonds, things like that. A smaller version of a marketplace, the smaller version sort of Fannie Mae, is called Freddie Mac. That's the Federal Home Loan Mortgage Corporation. So it's these three, but Fannie Mae is the biggest. Fannie Mae would just as soon make loans and package them up out of just conventional loans only because they're low risk, the lowest risk. And so you can't just throw in the VA and the FHA loans into the mix in the Fannie Mae marketplace without them being backed and guaranteed by the government. So Ginnie Mae steps in and says, well, we will stand in for these FHA, VA loans. So now the Fannie Mae marketplace can buy and sell packages of loans that are FHA and VA because Ginnie Mae backs them up. Here's what Fannie Mae looks like. I don't have it written at the top, but Fannie Mae purchases conventional as well as FHA and VA loans. It's the oldest marketplace and the largest of the three that we just looked at. It creates the marketplace for buying and selling those loans. It also helps the government put in place housing policies. When you hear of new housing policies going in, Fannie Mae is usually involved, the people of running Fannie Mae. It also manages and resells loans for the purposes of stabilizing the mortgage market. And it sets up those guidelines that those loan underwriters are using to make the loans. Why? Because this is where those loans are going to be bought and sold. Therefore, this is the best place to say, here's what we want those loans to look like. Here's the type of borrowers that we want in these packages of loans. So they establish the underwriting guidelines that are used. So this is Fannie Mae. This one is Ginnie Mae, a government agency under Housing and Urban Development, HUD. It works with Fannie Mae on the higher risk loans. It takes some of the risk out of the equation for Fannie Mae to feel comfortable interacting with those higher risk loans, pays the risk differential. If you're worried about the fact that this person is only borrowing 3.5% or only putting down 3.5% versus the 20 you'd rather they put down. It covers that difference. That's what mortgage insurance is about. The lender wants you to put 20% down ideally, but if you put 5% down, that mortgage insurance policy is covering that 15% difference between what you put down and what they would prefer to have, what they would have preferred you put down. So that's how much that policy is covering. Ginnie Mae allows investors to purchase shares in pools of loan. They put the loans all together and they sell shares in those big pools of loans. They sell those to investors and they pay directly to the investor. That's Ginnie Mae. And then Freddie Mac is this one, Federal Home Loan. They handle conventional loans, savings and loans, mortgage banks, and then they pool loans and sell bonds in that marketplace as well. Think of sort of like the stock market. You ever seen anybody ring the bell or hit the gavel in the stock market? Think of that sort of in terms of home loans, mortgages. To recap, we talked about the Federal Reserve System. We talked about the difference between the primary and secondary mortgage markets. We talked about who is in the secondary mortgage market, Fannie Mae, Freddie Mac, and Ginnie Mae. Talked about conventional FHA and VA loan types. Federal Reserve controls the money supply and the economy. And then we talked about RESPA and Regulation Z for the purpose of protecting consumers in residential loans. For trigger terms, it's things that affect the payment. Therefore, if you advertise something about the payment, you've got to advertise everything about the payment. If you disclose one thing, you have to disclose everything. And the protected classes, as per the Equal Credit Opportunity Act, include age, marital status, and public assistance. That is 14 and 15. Let's take a look at closing. I'm going to move on to Unit 21 in the book, closing the transaction. More math here. It's also the deep dive that you get into for post 302. So we're in book unit number 21. There we go. What are our objectives in 21? We're going to look more closely at RESPA. We're going to do a lot of level 3, pre-closing procedures, closing procedures, settlement statement itself, something called the closing disclosure. That's the document that you actually show your client that has everything they're either spending or getting money from. Our responsibility as a broker related to closing disclosure, basically anything from the contract, we have an obligation to double check and make sure they did the right math. Who's they? The paralegal. And then some calculations about prorating things like for taxes. We need to make it fair because whenever this closing happens, the seller is responsible for stuff about the house from January 1st all the way up to the day of closing. And then the buyer's responsible for the day after closing and then through their end of the year. And mostly that's taxes and a couple other things, HOA, expenses, things like that. So, for instance, if the seller has paid the whole year of HOA dues, then we're closing in September. We need to give them back some money. So, this is all about how to allow for that sort of thing. Remember, the purpose of this closing is to pass this property along, right? From seller to buyer. We're transferring title. We're trading, we're facilitating the clients trading the property for the money, for the consideration. What's consideration? What you're bringing to closing and borrowing. Not earnest money, not due diligence money. Those things are called liquidated damages. Now, yes, they will be included in the mix, and they will be counted as a credit for the buyer at closing. It's that much less the buyer needs to bring to the closing. But the consideration is basically the purchase price. And so closing settlement is the time at which all the funds are accounted for and dispersed involved with that closing. And this is the best way to have a termination of our contract and agency agreement, is to have a successful closing, obviously. Also, a little review here, the difference between a settlement and a closing. Settlement is the people signing things, signing off on all those papers that the attorney was preparing and the lender was preparing. The lender creates the loan package, which is basically a stack of documents. They will email that loan package to the closing attorney, and that paralegal will print off an inch or 2 inches worth of papers and give them to the attorney, who will then say, okay, buyer, sign here and initial here and date and sign and date and blah, 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 on and on and on, for about 45 minutes to an hour. You want the closing to be boring. Anytime there's excitement in a closing, it's never happy excitement. Sometimes it's happy, but it's usually at the very end that the happy excitement kicks in. But during closing, any sort of excitement is usually dramatic. It's not cool. So you want to keep it nice and calm and, oh, that's no problem. I've got that document right here. So it's settlements when we're executing documents and delivering them to the attorney. Closing is when finally that deed has been recorded, which allows the buyer to get their keys, the seller to get their proceeds, and finally, after all your hard work, you, the broker, to get your pay. So that possession, those keys, ideally should come to the buyer only after closing, only after the deed is recorded. Sometimes the seller's cool with giving them to the buyer earlier than that. Maybe as soon as things are signed, it's still going to be 2 or 3 more hours before the deed finally gets recorded. Maybe the seller says, I don't care. It's going to be fine. Just give them to them. I like these kids. And that's their business. You just want to make sure they understand, well, you really shouldn't be until it's recorded, but if you're okay with it, then that's really all that matters. As long as the seller's okay with it, they could let the keys be released. Let me fix that. So we also talked about that due diligence process, that time during which the contract has been signed and now we're working toward closing day. And it's that due diligence process that the buyer is just thinking about one thing. Do I stay or do I go? Do I keep going or do I terminate at any point? And so therefore, the deadline at which they could, the last chance they have to get their earnest money back is that due diligence deadline. Therefore, that's a time is of the essence. 5 p.m. on the date agreed upon. And I think we know that pretty well. What are they doing during this due diligence period? Well, the buyer is hiring inspectors at your suggestion, probably. You're probably going to be their main resource for telling them, hey, this is a good inspector, or here's a top 3 list of inspectors that have done good work. Therefore, consider them. They look to you for a lot of this sort of stuff. They might come along with their own. Maybe they have an uncle who's an inspector, but the buyer's the one who picks the closing attorney usually. If it's new construction, the builder might give the buyer incentive to let them use the attorney they prefer, and that just makes the process a little smoother. But in general, typical transaction, the buyer's the one who picks, because the buyer's the one who's going to pay more money to the attorney, by the way. The attorney's doing a little more work for that buyer also. The buyer has selected the lender and the inspectors and the surveyor and the homeowner's insurance. That's always the one that gets forgotten about till later. So you want to go ahead and be on top of it and say, oh, I'm going to go ahead and talk to maybe your auto insurance provider. Maybe they'll give you a package deal. Let's get some quotes from insurance companies so that we can hand that information off to the attorney. While the due diligence period is time is of the essence, the closing date is not, right? We need a little bit of flexibility, wiggle room in that closing date. Also, in that offer to purchase, standard offer to purchase 2T, even though there's a paragraph about the finance choices, that does not mean it's a finance contingency. There's not one. There is no financing contingency. Here it is. Let's take a look. Here's our offer to purchase 2T. We make our way on down. There we go. Funds needed to complete purchase. Is it cash? Check the box. Or no, it's a loan? Check this box. And what kind of loan is it? And they go into great detail. FHA, now that we know what that is, FHA loan, VA loan, conventional loan, USDA, or other. There's lots of kinds of loans. And then that these are all, what is the main kind of loan going to be? A first mortgage. And then what's the amount you're borrowing? That's important to share with the seller because the seller might feel more comfortable that the loan is going to be approved if it's got a lower LTV, right? More money the buyer's putting down. Then is there a second mortgage? Sometimes people get two mortgages to buy a house. They'll get a first mortgage for the most money, and then they'll get a second mortgage for the remaining little bit. And then is there some additional funds? Maybe there's some sort of a first-time buyer program, full disclosure basically. But it also says buyer's obligations here are not conditioned upon getting a loan. In other words, that buyer's still going to lose the due diligence money even if the loan does not get approved. So even though we have in the contract what we're telling the seller the kind of loan, it doesn't give the buyer any protection about getting money back if the loan is not approved. So no loan contingency. So part of that due diligence period needs to be as much time as you can possibly allow for having a really strong idea from the lender that they're going to give them the loan. It's not possible quite often to get full approval within the due diligence period that the seller is willing to agree to, but maybe you could at least have enough time to get conditional loan approval. All makes it all the more important to get a good, strong pre-approval letter in the beginning. Don't just kind of throw it at the wind and hope it works. Just kind of, you need to get a really strong indication that this buyer is going to be in good shape. Some lenders won't even give a pre-approval letter until they verify some things. And it's like a really strong approval process, but it takes an extra couple of days because they go to such lengths to make sure that they can give an approval, pre-approval that they're going to be able to stand behind that has much less chance of failure. What's the buyer worried about verifying? And you, as their agent, you want to make sure that anything they need to know about this property is figured out during this due diligence period, hopefully, so that they can still choose to not buy it if they find out some nasty surprise and get at least their earnest money back. But it's all these things. Pest inspection, meaning wood destroying insects, septic system inspection, utilities, street access, private versus public roads, all those things we've learned about. Underground storage tanks, fuel tanks. So the termites are a big deal here in North Carolina. They're a big deal in Florida too, but here in North Carolina, perfect conditions, right? Moderate temperatures, a little bit of moisture with a little bit of wood, and you've got happy termite. They're not a catastrophe though. It's certainly fixable. We know how to handle them. Sort of like heart problems. They kind of know how to handle heart problems. People can have heart attacks and still survive because we kind of have figured that out. Well, termites, wood destroying insects, not just termites, but there's also carpenter bees that can bore into wood and affect the structural integrity over time. something called powder post beetles. So it's not just, you might hear it referred to by some old timer as a termite letter, but it's really called a WDIR, a wood destroying insect report. And what is it reporting? It is saying that today, according to the things that I, the inspector, can see, there's no termites. But I can't see everything. It has a specific caveat in it that says, hey, I'm not taking out the kitchen cabinets and looking behind the sink and everything else. I'm just observing from what I can see without touching anything, basically. Even in the garage, a good place that they want to look at, um, termite inspectors or wood destroying insect inspectors, they would really prefer to be able to see the entire outline perimeter of the inside garage walls around the baseboards, because that's a prime spot for termites to come in. Let's see. Here we go. Oh, good. Popped right up. So here's a typical garage. If you can think about the garage floor right there, that garage floor is a slab of concrete, and that was poured after the house was built. So this spot where the floor meets the wall is not concrete. It's actually some sort of a filler material that termites can eat through. And so you can see it over here. The termites are blind. They build tunnels in which they can travel back and forth. So within this little mud tunnel, they can go up, eat some wood, and go back down into the ground, back and forth, like ants, except eating wood. And so this picture is the scariest. You see this little bit right here next to the sheetrock. That means they are in the walls. They are eating the studs of the walls. Now, a termite inspector is probably going to go into the garage there. They're going to see that at the bottom. They're going to probably go up a ways, punch a hole in the sheetrock, and see if that studded wall has termite damage. And if it still does, they're going to go up a little higher, punch another hole, maybe like a 6x6 inch hole, and they're going to follow it and see how extensive the damage is. How much termite damage is in there? Look how much this is. Holy cow. Those are some big old tunnels. That's just kind of scary and gross. So here's what it looks like. Here's what they do over time. They make that wood into cardboard, essentially, right? That has no structural value at all. And so that's obviously why lenders care about it. So sometimes the lender will require it, sometimes they won't. But you, the broker, should always suggest that your client have a wood destroying insect report, because obviously these things can really add up. Here it is on the outside of a foundation. It's quite often inside the crawl space. Here's some on the outside trim. See how it's kind of wavy right there? A good inspector is going to see that waviness. I mean, obviously they've already started poking, but they could see just a little bit of waviness, and they're probably going to tap on it, maybe with a screwdriver. And if that screwdriver is probably going to just go on in. And that's what has happened here. This is actually the screwdriver up here. And if they can pull it away, that's worthless, right? Now they know we have a major, major problem. By the way, to treat, oh my gosh, that's disgusting. To treat a house for termites once they're in involves a couple different things. You could spray poison, and they will basically like drill a hole maybe like 18 inches down through all the concrete around the whole perimeter of the entire house, inside the crawl space, and then across the front porch. If you've ever been on somebody's front porch and you've seen little holes every 1.5 feet down the line, but they're filled up, that's probably because it was treated for termites. And they'll squirt poison down there, and it disseminates, and it keeps those little critters from coming back up. It's effective. In fact, when you build a new construction house, that is part of the required process. That builder has to treat for termites that covers the first year. Here's what they look like. So that's kind of what we're talking about here. Big deal, especially if it gets into the joists underneath and the band sill, things that are affecting the foundation of the house. That's when floors start sagging because of the termites. Why did they come there? Well, because they sensed water and wood together, wet wood. So when you have a leak over time, that can be if it doesn't get caught, termites could be attracted because it's wet. It could also be a mold thing. It could be a rot thing. It could be like three major deals contributing to the structural integrity of this wood. Fun stuff. So that wood destroying insect report, it's not saying that inspector guarantees there's no termites. It's just saying I don't see any from what I can look at. But anybody been in someone's garage, whether your own or your friends? We stack those garages, don't we? We fill them up, right? The garages have more stuff than anything else. In fact, I encourage it. When I'm a listing agent, I tell my seller, I'd rather you box it up, put it in the garage than put it in the house because I want the house to show well. Well, when it comes time for that termite inspector to come along, they really want to see that baseboard. And if they can't see it, they'll write on the report, I wasn't able to see the entire room because of stuff stacked up. So that's what it doesn't report. They can't possibly promise and guarantee no termites anywhere because they're not going to look to that extensive level. Let's go ahead and have our break, and I'll see you in 10. continuing on in this under contract phase, what else are we doing during our under contract phase? Well, it's the time to have those inspections done. But then once the inspections are done, that inspector is going to give back a report. Inspections could include, of course, a basic inspection, structural and mechanicals, dishwasher, heating and air, water heater, roof. See, they're going to look in the attic. They're going to go in the crawl space if there is one. And then if that general inspector sees something sketchy, she's going to write it up in the report. She might decide it's not in her scope. It's more than what's required for a general inspection. She might say, oh, I'm seeing evidence of fungal growth. That's called mold. You need to get a mold specialist out here. Or I'm seeing a big crack in the foundation wall in the basement. You need to get a structural engineer's report. You need to let a structural engineer take a look at this. When it comes to house inspections and stability, a structural engineer is sort of the gospel, right, of real estate. They are going to say, here's what's wrong. Here's why this floor is sagging or this wall is leaning. And here's the required fix. Here's the best fix. And then you go out and get some quotes from a general contractor who does those kinds of repairs based on the advice of the structural engineer. To get a structural engineer out there to look at it and then to write a letter giving his or her opinion, probably at least $500 or more. Everything seems to start at $500 around this business. Whatever the inspections done include, they're all going to give a report. You're going to get this report as the buyer broker, and you're going to share it. They might send it straight to the buyer. At some point, you and that buyer are going to talk about these various reports. And with your guidance, they're going to decide what they want to ask the seller to fix. And so the potential outcome of that discussion is seller will either fix everything, or the seller might say, I'm not fixing anything. Have you seen the market we're in? I don't have to do anything. You can just go. I'll keep your due diligence money. You can go away, because that is true, right? That's the deal. It's non-refundable, even if the seller won't fix stuff that shows on the report. That's just the risk involved. But there are still sellers out there who, I guess, have sort of a conscience. Maybe they're willing to fix certain things up to a certain point. Maybe just because they want to keep this buyer in place because they have time issues built in. They can close sooner if they just fix this item and move on with this current buyer instead of putting it back on the market. So not every seller is all about trying to not fix things. You're going to help your buyer figure out what to ask for, and you're going to prepare the document for that. And let's see here. Show you what that looks like. The document that you use to ask for repairs is called a due diligence request. That's the form with which you're going to say, look, based on these inspections we've had done, we want you to fix items 3, 5, 7, and 9. And that starts the negotiation. So the negotiations are not just about the price. That's just in the beginning. Price and terms is in the beginning, and then the repairs are during the under contract phase. Closing in on it. I'll have it here in just a second. What if instead of the due diligence request, one's better, they want money instead? Well, there's another form for that. This one is called an agreement to amend. And so if that's what you want to do, it might be just that you include. You're the source of it, right? You're the broker responsible for reasonable skill and care, meaning you've got to know what to use to accomplish the goals of your client. Here is let's look at this one first. Here's the one you would use to tell them what you're wanting fixed. If what they want is for them to fix items 3, 5, 7, 9, and 28 on the inspection report, it would be this kind of thing. A due diligence request between buyer and seller, fill in the blanks for this property. And then you use all of these fun lines to be as not creative as possible. You keep it simple. You don't say, item 3, repair the termite damage. No, don't get into any of that. Just say, item 3 from the attached inspection report. Let the report speak for itself. You're not the inspector. Buyer requests and seller agrees to the following. Here's what they're asking for. And then we pass it along to the other agent. You do check the box here whether or not the buyer is going to agree to release the inspection report to the seller. It's good to do it for a couple of reasons. Some buyers might say, well, I don't want to do that. I bought that report. It belongs to me. Well, it can help the buyer because, number one, it gives the seller nice, good pictures to look at to see what's wrong so they can get good quotes and figure out what the repairs need to be. Number two, if they have agreed to release the report, that means you or their buyer agent have sent it to the listing agent. That means that listing agent has seen material facts about the property. And you're sort of passive aggressively laying it on that listing agent that, hey, you better agree to this stuff. Hope we can work it out, because if this thing falls apart and you go back on the market, you, Mrs. Listing Agent, are now responsible and required to disclose everything in this report that's a material fact. Oh, yeah, that's a different spin. Sometimes you look after the fact and you don't see anything. A deal falls through and you follow up with it a couple of weeks later. You look on the MLS and there's no mention of anything being repaired. But that's what should happen, or at least new disclosures. Yeah, the disclosure from the seller can still say no representation, but the broker's now got to disclose because they know stuff from the report that you got authorization from your buyer to send to them. That's why it's usually a good idea for you as the buyer side, selling agent side, to send them the report. And then, of course, your buyer signs, and then when the seller, if they agree to everything, they'll sign. They might not sign. They might say, yeah, I'll agree to 3 and 5, but not 7 or 9. And it'll be a back and forth negotiation. Then when you finally figure it out, probably best practice to make a new one, nice and pretty. Now, again, this is only for repairs. It would be incorrect to write in somewhere. Also, seller gives the buyer $3,000 for window allowance. No, you don't do that on this form. You don't write that in. You would do such a thing on this form. Anytime you're adjusting money instead of repairs, you're going to do it on this thing. This is a big fat amendment form, multi-use. If you need to change the price because of the repairs, instead of fixing anything, the seller just says, well, how about I just take $420 instead of $425? Side note, most lenders would rather not change the price halfway through the loan approval process. Let's leave the price alone unless you just have no other option. Rather than change the price because of repairs negotiations, how about we go down here and say the amount the seller will pay at settlement toward buyer's closing costs is going to be this much. Now, that works great for handling repair negotiations. The seller's going to pay toward the buyer's closing costs. Those are a lot. There could be $10,000, $15,000 worth of closing costs that buyer needs to pay. And if the seller will cover some or all of that instead of repairing, that could work great. The only problem with this is it's not open-ended. It's not just a blank check. The lender, the buyer's lender, puts a limit on how much they allow the seller to pay toward the buyer's closing costs. It depends on the type of loan. Typical conventional loan will allow no more than 3% of the loan amount to be paid for the buyer by the seller toward their closing costs. So maybe your initial offer included asking for some closing costs. If that's the case, you may not have as much wiggle room to work with when it comes to negotiating repairs. What if you need to change the settlement date? We know we have a built-in 7 days, but we get all the way to the original closing date and then the beyond 7 days past that. Then we need to do this form to go even past that further. Sometimes you need to change the attorney. If that's who's holding the earnest money, then we need to change the escrow agent and acknowledge that on here too. Or if we need to bump the due diligence period, that's a time is of the essence date. But sometimes things don't get done in time, and it's the day of due diligence, and everybody realizes, wait, the seller hasn't agreed to the repairs. If we go past the due diligence deadline and the seller hasn't agreed in writing that they're going to fix stuff, that buyer is basically saying, okay, I'll take it as it is. So that buyer might need to say, look, seller, what are you waiting for? The seller might say, I'm trying to get the quote from the last general contractor. I haven't heard back yet. And the parties might agree, look, we need to get some more quotes. This due diligence deadline is not enough time because of the situation. How about we go another week on the due diligence period? Sign here. This is where you would change the due diligence period if you needed to bump it, so that your buyer doesn't have to terminate the contract because the seller couldn't get quotes back from repair people or something. And then sometimes if the buyer asks the seller to change the due diligence period and give them more time, that seller might say, well, that's going to cost you. You gave me due diligence money, but that was up to this date. You want another week? You're going to need to give me another $1,000. And so if we needed to adjust the due diligence fee, this is also what we would use to do that. Earnest money, if we need to add to earnest money, and then, of course, price we talked about. So these two are the documents we use the most during the due diligence period to handle repairs and further negotiations after the initial stuff. So, repair negotiations. For the test, for this class, do you need to have everything fixed? Does the seller have to get the repairs done by the due diligence period? Or do we just need to have it in writing that they're going to promise to do it by the due diligence period, and then they have whatever time is remaining till closing to actually get the work done? A or B? Do they have to get the work done? That's A. Or B, do they just have to commit to getting the work done in writing? B. Yeah, there you go. There you go. That's an easy test question. You might very well see. When are negotiations completed? End of due diligence period. When are repairs completed? Just as long as they're done by closing is fine. What choices does the seller have when asked to fix stuff? Well, yes, no, or somewhere in the middle. Or part of that might be, I'll fix some stuff, but I'll just give you money to do some other stuff. Or it might be, let me just give you a lump sum chunk of money because I don't want to even hassle with contractors and repair people. Can't I just give you more toward your closing costs? No matter what is agreed upon, it's got to be put in writing. And if there's any money involved, like a price change, a closing cost change, all of that has to be transparent and disclosed on the closing disclosure. Otherwise, you're guilty of something really serious called loan fraud. Any idea what the penalties for loan fraud are? A, here's your choices. A, 30 years in prison. B, $1 million fine. C, 10 years in prison. C or D, $10,000 fine. I don't remember what those choices were, but you tell me what you think. Multiple choice too, by the way, more than one answer. If you commit loan fraud, that could be as simple as not disclosing money on the closing disclosure. The lender is the one we always check with. If somebody asks, well, what are we going to do about this amount of money being paid by well, let's see if the lender will allow it. That should always be the first question. Make sure the lender's cool with it. Make sure we put it on the closing disclosure. If it's not on there, that loan fraud is a big bad beast. 30 years in prison you could serve. 30 years. Isn't that coincidentally the same number that most mortgages last? $1 million fine. That could be broker. It could also be lender for loan fraud. Another common way loan fraud pops up is with like a first time buyer. What do first time buyers need help with? Down payment, quite often. So what do? They ask parents for down payment. Hey, mom and dad, can I get a gift? Will you sign this letter saying you're gifting me $10,000 for my down payment? That's fine, but it better be true. What if you're driving them around like in the old days? We used to actually drive them to see the properties in the same car. We haven't done that in forever. I haven't. Um, but if you're driving them around and they're in the back seat and you're driving them like Miss Daisy and they're like, hey, mom, by the way, thanks so much that you and dad are loaning me this money, loaning me this gift money. I'll be sure and pay you back when I get my tax return refund. You just heard not loan fraud, but the intention to commit loan fraud, because that would be loan fraud. It better be actually a gift. If the borrower is expected to pay it back instead of just having it as a gift that's not paid back, that could affect their chances of successfully repaying the loan. That's why the lender cares about it. Because if they're trying so hard to pay mom and dad back, even though that was supposed to be a gift, but it was really a loan, and in the process they end up defaulting on the actual mortgage, well, that's something the lender deserves to know about as being a potential risk that they should have had a chance to factor into their decision process of approving the loan. That's the logic behind it. So that loan fraud thing is big. It's a big deal. Once upon a time, there was a broker when I was brand new. She was a hot shot in South Charlotte, man. She was killing it. She was a single mom of 3 kids, and she had just hit her stride. She was selling, I think her minimum was $500,000, but she was frequently million plus, to the point where she was running advertising where it's her in a limousine, like those Homes books where you have the listings in grid, and at the top it's a banner showing you and you're doing something with your phone or something kind of cool. She was in her banner photo hanging out of the top of the limousine, and she said, this is how I show houses to my buyers. And I thought, well, number one, jealous. I wish I could do that. Number two, I don't really think I'd do it if I could afford it, because good luck ever negotiating your commission if people see you riding around in a limo. Come to find out, this lady had been approached by a man who wanted her to be the real estate agent in his deals. He was an investor. He called himself a consultant. And before she knew it, he had connected her with an investor and an appraiser and an attorney, and he was the consultant pulling these deals together. She did the real estate part. He ended up getting paid in a way that wasn't allowable. And one day it was all going great until it wasn't. 2 men showed up at her office wearing suits. And she, in the book she wrote after the fact, said, these are 2 good looking men in 3-piece suits. And I thought, wow, happy to meet with these guys. And she went into the conference room and their jackets kind of fell open. And there were the badges and the guns. The Charlotte location of the FBI investigating mortgage fraud. And they said, do you know this person? The name of the consultant guy. And she said, yeah. Have you been doing transactions with him? Yeah. And they asked questions. And about 5 minutes into their questioning her, they said, you know what, ma'am, you probably need to just stop talking and consult an attorney, and we'll be in touch. And I thought that was very nice of the FBI, because in my experience, which is TV and movies, she should have been in a basement underneath a light bulb being tortured and questioned for like 48 hours. But she got out of that meeting. She went to her broker in charge and she said, oh my gosh, this just happened. And the BIC said to her, what? No big deal. It happens sometimes. And when I read that, I'm like, time for a new BIC. Long story short, she ended up doing time. I think maybe even a couple of years, but I'm not 100% on the duration, in literally Martha Stewart Prison in West Virginia, the same one that Martha Stewart did time in. For what? Loan fraud. She got tied up in, and she says in her book, the good happy ending there is she did her time. She came out. She started going on a speaking circuit. talking about the experience. And hey, brokers, be careful. She said, I felt like the little voice in my head, and I guess I kind of, in retrospect, knew it was wrong, but I just kept going because it was working so well. So just be careful about loan fraud. And that was her story. And she probably ended up making more money with the book and the speaking engagements than she ever did in real estate, although she was doing really well in real estate. I'm going to put her name there in the chat for you. You can look her up and buy the book if you want to read more about it. But she was a Charlotte agent, and she's going strong. She's out. She did her time. And one other thing was she had to, of course, talk to the real estate commission when all this went down. And she goes into detail of that phone call. She was on the phone with her attorney and then the real estate commission person on the other end. She's talking about listening, hearing them breathing while she's telling her side of the story. And would you like to guess what the real estate commission ended up doing and telling her? They of course required her to return her license. But how much time do you think they gave her to stop doing real estate? Let me give you some answers. 1 month, 3 months, or 9 months. You're learning my tricks, aren't you? Just pick the biggest number. That's it. They gave her 9 months. They said, you know what? You admitted you did wrong. You came forward. You've given us the answers and the story. You got in front of it. We also we're accounting for the fact that you're the sole breadwinner for your kids, still single parent, and then that you have several closings lined up that need to happen and then you're going away, not earning for a while. Therefore, we're going to give you 9 months to get it all settled, get it all cleared up, get your last few closings closed, paid, so that you have some money to help support your family before you spend time away at camp. So I thought that was pretty decent. The lesson there is get in front of the bus, right? So watch the loan fraud. Now, we've negotiated negotiated the repairs based on all those inspections. Now it's time to make sure things got done. You, the broker, are in touch with the other broker, and they've probably kept you up to date, and they've said, look, we had this thing fixed this week, the other thing's coming next week. Whenever they give you the final word, everything's done. Maybe it'll be as much as a week before closing, if you're lucky. You definitely want to at least do a walkthrough on the day of closing or the day before. You always want to do a walkthrough with your client, the buyer, to make sure the house is pretty much in the same condition it was when they fell in love with it and decided to make an offer. But to take it a step beyond that, here's what could happen if that's all you ever do. If there's a substantial list of things needing to be fixed that the seller supposedly fixed, and if you don't do the walkthrough until morning of closing, and you're headed to the closing after the walkthrough and the closing's at 11 and it's currently 8:30 or 9, and then you find out, oh, wait a minute, they did 3, 5, and 7, but not 9, 11, or 17. That is a bad feeling, because can they possibly fix it and get the remaining things done that they promised were done in 1.5 more hours? Probably not. Now we've got a buyer who's ticked off, a seller who may or may not be ticked off. It may not be their fault. They might have entrusted someone else to do it and they just didn't follow up. It might be that they did it on purpose because they knew the buyer would be desperate and would go ahead and close even though things were left unfixed. I tend to, I'll trust but verify. I'll be nice as the buyer agent. I'll call the listing agent. I'll say, look, I'm sure this is a surprise. I'm sure you thought everything was fixed because you told me it was, but it's not. Wouldn't it be nicer if you, as soon as you got word that it was fixed last week, still a week to go, that you, even without your client, if they couldn't make it, you go take a look. Do your own little preliminary walkthrough. Now you can say to that listing agent, oh, you know what? I think you said it was fixed, but I guess you, the person maybe didn't tell you the whole story, but it's clearly not. There's still a couple of items. Oh, good thing we have a whole week to get it fixed. Isn't it much nicer that you have that backup plan so that the day of, you might have even gone out 3 or 4 times to make sure it finally got fixed. You just don't want to put yourself in that box, or more importantly, your client in that box, where they kind of feel, because a buyer, they got loan approval, they've hired a mover, all their stuff is on the truck, it's in the parking lot at the attorney's office, or worse, the house that they hope to close on today. And so they're just waiting for the keys. But now the closing's going to be delayed, maybe. They're much less likely to use the only leverage they have. The only leverage they have is, I'm not signing until you do everything you promised, including fixing these things. But if they have all that other stuff going on, they're a lot more likely to go ahead and close and sign, and then hope the seller actually goes through with it after closing, but a lot less leverage there. And then, yeah, you could set aside money in escrow to be used to fix blah, blah, blah. Let's just get it done ahead of time. Yes, that's a good part of it. You just want to make sure, Ben says there in the chat, do you have to schedule a time with the sellers to go make sure those things are fixed? Oftentimes you're going to see those things without the seller being there. It's usually preferred that the buyer and seller aren't in the same place at the same time. But you know what? A few times where that has happened with me, it's actually been a good thing. They, as big and tough as people behave facelessly, as is the case on social media, by the way, when they get face to face, they start to be a little more polite. Manners start being coming out usually. And issues that were issues are no longer issues, because it's like, oh, that's a real person buying my house or selling this house. Therefore, you know what? I thought it was I cared, but it's not as big a deal as I thought. Don't worry about it. It really can solve some problems. But yes, you do want to have a time to make sure things were fixed, ideally, but you definitely need to do at least a final walkthrough. It's just my extra advice, not on the curriculum, to do that walkthrough as soon as you can, days before closing, to allow for the possibility that they didn't actually fix everything. What are we looking for in the walkthrough? To make sure it's pretty much in the same condition as when they chose to buy it. We know this part. After that due diligence deadline is passed, the earnest money is in jeopardy. Now the buyer's not getting it. Even if they back out, they can still back out. What if the test question says, can the buyer back out after the due diligence deadline? Can the buyer back out after due diligence has passed? Yeah. What is the consequence? It's not DD money. They've already lost DD money. They lost that on the first day. Now they're losing earnest money. Yeah. Now it's the earnest money. The due diligence money was gone from day one, the minute it became a contract and got turned in. Yep. So it's just money. It's a money thing. The buyer can still walk, but they're losing now earnest money. So we know what the buyer cares about. It's all about repairs and inspections and appraisals and surveys and making sure, do they want to keep going? What is the seller concerned about this whole time? Making sure the buyer keeps going. And also, part of that, did the lender approve it? A good listing agent's going to call you from time to time and say, hey, how does the loan stand? How are we doing on the buyer's loan? Has it been approved yet? So that's what that seller cares about, the money. And then those contract terms, are they completed? Is the buyer doing what they're promised to do to work toward a successful closing? In the meantime, we know what the buyer and buyer agent are doing. We know what the seller and listing agent are doing. But what's also happening is the closing attorney, probably more specifically the paralegal, but the attorney actually does do a title search. They are researching the deed. Remember the Marketable Title Act, which says do a title search using the grantor grantee index back to 30 years. Anything that went crazy past 30 years ago doesn't matter. It can still be a clear title as long as the last 30 years are good. They're checking mortgage payoff. The attorney, paralegals, they're getting information from both the buyer and seller side. They want to know from the seller, what's your social security number? What is your current loan number? Who is it with? So that we can contact your current lender, Mrs. Seller, and find out what your total payoff needs to be. Because we're going to take that amount of money from your proceeds and send it straight to the lender. You're not getting that. The seller doesn't get the big lump sum and then pay it off themselves. The attorney is going to send that loan payoff to their existing lender for them to make sure it happens. Probably more likely it wouldn't happen if we just gave the money to the sellers and let them just get around to it whenever they wanted to. It needs to happen ASAP because now there's no more collateral in place to protect that lender. So that mortgage payoff is going to be handled. It's one of those few things the lender is doing for the seller. The attorney. Most of the things the lender's doing are for the buyer. But the couple of things the attorney is doing for the seller is the deed preparation and the mortgage payoff. And maybe some random little legal documents as needed. It might be that the buyer and seller agreed to sell some personal property. Like if it's anything more than the refrigerator, washer, and dryer, just for your information, the lender doesn't want it to be in the contract. The lender, anytime we're dealing with personal property, you have to think, again, let's check with the lender on that. Because if the lender sees that the seller is including leaving behind the washer, dryer, the refrigerator, the dryer, washer, dryer, refrigerator, the big office desk, the big 1,000-pound desk in the office, the sectional couch, the pool furniture. If we write all of that stuff in the contract, most likely the lender is going to look at it and say, nope, not happy with this. Are you buying a house? You want us to loan you money for a house, or do you want us to loan you money for personal property with a house around it? They want most of the money they're loaning to be for the house. And they will usually say, the only thing we're okay with being in the contract that's personal property is the refrigerator, the washer, and the dryer. All this other furniture and stuff, you need to handle separately. Get it out of the contract. We don't want it there. Because our mortgage money that we're loaning you is not for stuff, it's for real estate. Therefore, a personal property bill of sale, that's where that comes in. You would say, the broker would say, hey, attorney, we need you to draw up a personal property bill of sale so we can list off the desk, the couch, the statue, the fountain, the this and that and the other, and make sure we have something in writing to protect the client, even if the seller's just including it with the house for like $1, whatever the minimum is, just to have something documented without it being in the contract to satisfy the lender's requirement. And then, of course, the attorney is also checking for mechanics liens and other kinds of liens too. They're going to ask the seller, hey, seller, have you had anything done that is still an unpaid bill in the last 120 days? What a specific number of days. That sounds a lot like mechanics lien days, doesn't it? Because they have 120 days to file a lien. Therefore, the attorney wants the seller to say, anything we need to worry about that's happened in the last 4 months? That's what this is about. These are the things the attorney is going to want to know from the seller. The attorney is going to get that loan package from the lender that's like 2 inches thick once you print it out. All the loan documents. They're also going to get the title insurance. They're going to do the title search, get the title insurance policy company to issue the policy. They're also going to talk to whoever the buyer chose for insurance, for property insurance, get what's called a binder from that insurance agent to see how much they're insuring it for, to make sure the lender's happy with it and everybody's cool. They're also going to possibly, but not automatically or necessarily, get a wood destroying insect report, WDIR. That's not necessarily required by the lender, but it's just smart to have it done. And if it does get done, let's go ahead and give it to the attorney because we want it to be signed off by the parties. And then a survey. It's always good. Why is it good to get a survey done by the buyer when they buy the house? Do you remember that little nuance? It's a good guess. That's a good guess, but it's a little more specific. The survey is the best way to discover encumbrances. So, why do we care about encumbrances? Who would care? What would an encumbrance do to the title if there's a fence over the line? Either way, yours over the neighbors or the neighbors onto yours. Either way, what does it do to the title? Yeah, colors the title, makes it cloudy title. Yeah, and so therefore, the title insurance company won't cover encumbrance related issues that could possibly pop up unless the buyer gets a survey done when they buy it. If the buyer relies on the seller's survey instead of having their own done, then the title policy won't cover potential encumbrance problems down the road. Why? Well, because if they had the survey done, they would know that there are or are not encumbrance issues and they could deal with them. So that's the reason you should suggest to your client to get a survey, because your title policy won't cover as much stuff like for encumbrances. Therefore, you need to it's another $500, maybe even more. Get the survey done. Oh, I don't want to. Okay, then sign here saying I told you to get it done. Because next year, if it bites you on the bottom because you didn't get it done, don't come to me and ask me to reimburse you because I have it in writing that you denied it. That's just the main thing as a broker that you want to get accomplished. We talked about title insurance a little bit. It's paid one time. It's not a recurring thing. It's not like PMI or MIP. Title insurance paid once. It's a great deal for what it is. Protects forever. One lump sum chunk. Not that much money either. It's paid once by the buyer. And it includes, if you're getting a loan, it includes two policies. An owner's policy that covers the value of the property just forever. And then a lender's policy that only covers the loan amount, which means as the loan amount decreases, the coverage decreases until eventually that lender policy is not needed anymore. At which point? That's at the point when the loan is paid off, right? So here's that title search process. The attorney investigates the history, making sure that you're buying it from a seller who bought it from a seller who bought it from a seller. No surprise owners along the way. No mysterious unknown people that needed to sign but weren't around. Clear chain of title. The attorney then gives an opinion and says, look, it looked good to me. I'm giving my opinion, preliminary opinion of title being clear. And then based on that attorney's opinion, the title insurance company will say, okay, we're going to grant the policy. And that's the process. Who can do a closing? Well, obviously an attorney, but in North Carolina, it doesn't have to be an attorney. You can have a non-attorney conduct a closing, because all a closing or a settlement really is here's a document, sign here and here and here. But the issue there is if you do choose to have a closing handled by a non-attorney, then you better have an attorney available on speed dial to answer any legal questions. And I've done it many times, several, I would say many, handful of times. Not because I wanted to, but because it was best for the client. In one case, she had already built her new construction house, and then she hired me to help her sell the house she needed to sell. So she was moved into the new house, and we went to that new house, she and I and the other agent and the sit-in, fill-in settlement agent that was a non-attorney. And that person just sat there and said, sign here and here and here. Is more involved in that, but that's basically what they did. And inevitably, it's always the case that I've ever been, someone does have a legal question. So that person who's not an attorney who's facilitating the closing has to say, well, hang on, let me call them. All right, they're asking this. Here, let me let you speak to them. And we get the legal question answered, and then they keep telling them where to sign. Even you as a broker could be a settlement agent, a non-attorney settlement agent, but the commission would rather you not. It just gets a little weird. That buyer is the one who chooses the attorney and where and when, usually. Here it is. No, not quite. But yeah, it's the next slide. In some other states that are not North Carolina, they handle closings and they call it an escrow. With escrow types of closings, it's an impartial third party. We don't do that here. We have an attorney that's hired and represents the buyer. Yes, the seller could choose to have their own attorney also. It's just unusual. If they want to, they would need to pay for it. What is their attorney going to do for them? Maybe their attorney on the seller's attorney is going to actually prepare the deed. Then they would send that deed over to the buyer's attorney who's actually handling the real closing, and then they would invoice them for that deed preparation. Deed prep tends to cost, in this class when we do the math here in a minute, we'll see deed preparation show up on the exercises of like 200 or 300, but it's really more about like 500 or 600 nowadays. So mostly the attorney is hired by the buyer, therefore representing the buyer and the lender. But there's just a couple things that the seller needs done that is okay for that attorney to do for them, which we've already talked about. Preparing the deed, and handling their payoff and whatnot. Here it is. Does an attorney have to conduct the settlement meeting? No. It can be a non-attorney to do that. Just have to have an attorney ready to answer questions if needed. Are the buyer and seller required to be there together? No. And even, of course, in the last couple of years with that illness that shall not be named, it was even more of the case that it's good. This is how it is. But it had already gotten to that point because historically, back in the old days, you'd have buyer and seller across the table from each other. Where am I here on the, okay. And as the attorney is helping one sign stuff, the other one's hearing all of their business and back and forth. But they started realizing, look, why are we doing it that way? Let's just get the seller in here and do their stuff and send them away because they can be done in about 15 or 20 minutes. Now let's get the buyer in here, and it's just the attorney and the buyer's agent, and they can take their 45 minutes to an hour, hour and a half, what's needed, depending on the questions. And the seller doesn't even need to be hanging around for all that. So that's really the way it's handled. Quite often, there's no requirement for them to be there together. And it's actually better if they're not. But what about us brokers? Do we need to be at closing? Tell me in the chat. Sometimes I give you the answer on the slide when I ask you the question. Yes, you bet. The real estate commission says, hey, broker, what else are you doing? This is sort of like the Super Bowl. You did all that work to get to this point. Don't be lazy and sit at home and then come later this afternoon and pick up your check. Be at the closing. The commission says if a broker is not attending settlement, that is a violation of their fiduciary duties. They need to be there. And it's just smart. It's just good for the likelihood of the successful closing. I've had cases where, frankly, if it weren't for me, they wouldn't have had the document they needed in that moment to go ahead and close right then. It would have been a delayed closing, maybe the next day, maybe the next week. I'd rather get paid today. Let's just be there, help fix problems that pop up if they pop up. But more than anything, because these guys tell us to, the commission says be there. We need to be there. Closing accomplishes two things. It makes sure those promises from the contract are fulfilled. It also makes sure the buyer's loan is finalized, approved, signed off, funded, all that fun stuff. Speaking of funding, the parties have shown up. Seller probably got brought back first. So it was the room with the attorney, the seller, and the listing agent. They signed their stuff, took 15, 20 minutes, they're gone, including that agent. Now the buyer agent, and the attorney, same attorney is in the room. They sign a bunch of stuff, and they leave. The attorney says, hey, buyer, no, sorry, you can't have the keys yet. The seller won't release the keys until it's closed officially. It's not closed officially until it's been recorded. We don't walk to the courthouse to record anymore. They rarely do anymore. They used to. They used to send a paralegal to the courthouse while people were still sitting in the closing room, and then she or he would call back and say, "Hey, attorney, it's all good. I recorded. You can disperse funds now," and we get our money and we go. But that's not the case so much anymore. Now the recording is handled online, but again, it's still done in real time. It's got to be done before 4 when they close. But even though you're online, you see your place in line. It'll say, "I'm 14th in the queue." And then sometimes a paralegal will come back if you're waiting. Sometimes they let you wait. And then she's like, "Oh, now we're 10th in the queue. Okay, now we've moved up to 8th or 7th or 6th." So yeah, it can take a while. But that's just waiting for it to record. Before that, all those documents the buyer just signed need to be scanned and sent back up to the lender to make sure that they like how it looks. Did they hit every place? Dot every I, cross every T, initial, date, sign in the right places with the right names. Some documents need full names. Some documents can only be the first and last. It's okay. All that stuff has to be verified. And then, yep, okay, we'll fund the loan. It's clear. You have the go ahead to use the money we wired you, attorney, because the lender has probably already wired the full $800,000 or whatever the loan amount is into the attorney's account. And now they've said, "Yep, everything looks good. Go ahead." You can disperse funds. You can, well, record the deed and then disperse funds. So, in other words, from the moment everybody's finished signing to the moment that the deed gets recorded could easily be 2, 3, 4 hours. That's why good business practice, try to schedule morning time appointments to allow last minute delays and still give enough time to close that same day. That's why also people like morning time closings. And then we also like, well, I don't know that we like them, but there's another reason that closings tend to happen at the end of the month. And we'll talk about that when we get into the math in a little while. Let's go ahead and get into the break. I'll see you in 10. closing in. The last 50 minutes or so. Okay, we had a question in the chat. What about situations where it's a mail away closing? What that means is Gary's talking about the case where the attendees, buyer or seller and or can't be there. And so a couple options. A mail away means the attorney prepares all the documentation and literally FedExes it, overnights it to the party, whoever's there. It's quite often it's more the case that maybe it's a spouse situation and one of them can't be there, so they have to mail away to the other one. If that's the case, the other choice would be, instead of a mail away, to give the spouse who will be here power of attorney. But in whatever the event is that requires a mail away closing, all of the signing is going to take place before the official closing day, so that the attorney will prepare the documents. They'll mail them off along with another envelope included, so the person there can sign. They'll probably need them to sign in front of a notary public. So they'll maybe go to a bank. They always seem to have a notary around. They'll sign the documents in front of the notary, have that notarization seal put on the documents needing notarization. They'll shove it all in the included return envelope, which has prepaid overnight fees, and they'll send it back. Then we can still proceed as scheduled. It's also possible, if you're the listing agent, that you can tell your seller, look, guys, if your schedule requires, we could check with the closing attorney and see if you can come in and close earlier than the actual settlement day, maybe a day or 2 or 3 earlier. As long as the attorney has time to prepare the documents needing seller's signatures, they're usually willing to do that if they can fit them into the schedule. If it's the end of the month, it's harder to fit things in between closings because most people want to have closings at the ends of months. It goes back to the buyer, the way the buyer handles their new house payment. They don't have to make their first house payment until the following month. So if we're closing, what are we on? If we're closing on December 27th, on that day, then they do not have to make a house payment. The buyer, new house payment it's not due on January 1st, because when you own a house, you pay your house payment after you live there. It's called in arrears. You pay in arrears. So if you're closing on December 27th, your first normal payment isn't due until February 1st for the privilege of having lived there in January. But that still leaves 3 days, 27, 28, 29, well, actually 5 days, because in real life it's 31 days. 27, 28, 29, 30, 31. 5 days of interest payments that your new lender wants you to pay them, you the buyer. Buyer's got to be charged for 5 days of interest from the December 27th through the end of month. Well, if the buyer has limited funds available for down payment and closing costs, then they want to minimize how much they're going to need to pay for this remaining days in the month. Therefore, they tend to want to close toward the ends of months. We'll talk about that, and we'll learn how to calculate that at the end of this chapter. That thing about requiring the deed to be recorded before the funds can be released, that is required under what's called the North Carolina Good Funds Settlement Act. Good funds, meaning make sure that all liens have been handled and accounted for. So we record without any lien issues, and then we can disperse funds safely from there. So what's recorded? Both the deed and the deed of trust. The documents that are recorded after a settlement are these two things, deed and deed of trust. What's the deed? Tell me what the deed is in the chat. It's another word for deed. Simple one-word explanation. There it is. Thanks, Matt. Title. Yeah. Deed is the title, the thing that says you own it. And then the deed of trust. What's the deed of trust? Yeah, it's that lender document that pledges the property as collateral. It's the deed. It's the one of the two lender documents that's involved with the loan, the major loan provisions. The deed of trust is the one that says, yeah, you can foreclose on it if I don't live up to my end and keep making my payment. The other document is the promissory note that says how much you're going to pay over how many payments, blah, blah, blah. But the promissory note doesn't have to be and is not recorded. Just the deed of trust is recorded. So the last things that happen upon closing is that title is updated, making sure no other liens right before they finally do the final recording of the deed. The deed of trust itself is recorded, so now the whole world has access to the fact that you have pledged this property as security, you, the new buyer. The seller's liens are paid off at closing and therefore canceled, so no longer do they have these liens over their head because the property that the liens were attached to got sold, and now those liens were paid. Now they're canceled. Funds are given out to the seller, maybe to the buyer in some cases, also to the brokers, because they're the last to get paid. We are. And then that sale, the fact that the property was sold, one of the many documents signed is an IRS document saying, yep, I sold a property. And so that sale is reported to the IRS. Now we're done. So a closing disclosure is one of the main documents that is signed. There's a seller's closing disclosure and there's a buyer's closing disclosure because they each side has different things. They have different debits and credits. A debit is something you have to pay for, just like your checking account. And a credit is something you get credited with, right? Something that comes in versus goes out. So the closing disclosure outlines and lists and details all of any expenses and credits and debits for both sides. The closing attorney or the settlement agent disperses funds from their trust account. If that earnest money was in their trust account, they're going to release that and use that as a credit to the buyer's side at closing. And then the requirement by RESPA is that the buyer gets their closing disclosure no later than 3 days before closing. That is a testable item. When does the buyer have to receive their closing disclosure? No later than 3 days before closing. When does the buyer have to receive their loan estimate? The answer to that is 3 days as well. It's 3 days after loan application. Oh, wait a minute. Loan application. He said that phrase a minute ago, like an hour ago. Do you remember what signifies loan application? Yeah, there it is. Thank you. In the chat there, Carrie says when they get the property address. That's it. Now they've officially got a date for loan application. Now that lender is responsible and required to give that buyer the loan estimate form. The loan estimate looks very much like the closing disclosure. They are intended, again, for full transparency. Here's an example. It's not green. The green is just for highlights, but they all look this way. They all have these same things in the same spots. Here's page 1 of the loan estimate. It's got the duration of the loan in the top right. What's the reason for it? Is it a purchase or is it a refinance, for instance? Is it a fixed rate conventional or is it an FHA or VA? The type of loan, the loan number. Is there a rate lock? All of this is in the same spot so that if a buyer needs to compare two different loan estimates from different lenders, they know where to look. Before this was required, it was really hard for buyers to track down all the different lender fees. And it was hard for them to compare two different lenders, what they call apples to apples, right? And our job was that we, as brokers, needed to help them figure this out. That's a good question, Lillian. What happens if you don't get the CD, closing disclosure, 3 days before closing? Is 3 days before the closing. What happens is we don't have closing on that same day. So if, for instance, we're going to close, let's say, what is it? Let's say today is Tuesday, and we're supposed to close on Friday of this week. So today is Tuesday. Let's see, that would be Tuesday to Wednesday to Thursday to Friday. Well, we better get our CD. The buyer better receive their closing disclosure on Tuesday, because that gives Wednesday, Thursday, Friday, 3 days before closing. Well, what if Tuesday comes and goes and no CD? And then Wednesday around noon, the lender calls and says, I'm sorry, we just haven't gotten it finished yet. We can't get it to you till tomorrow. So you're not going to get the closing disclosure until Thursday. That means 3 days from Thursday is the soonest you can possibly close. Friday, Monday, Tuesday. Now Tuesday is our closing date. When that was a first proposed rule change, it freaked everybody out, because before then it was quite common that a buyer didn't see their closing disclosure until the morning of closing, maybe even sitting there at the table. So that had to change, and so that's why it changed. And you know what happened? It wasn't that big a deal. The lenders adapted to it. They figured out, okay, we just need to get this to them, so we'll do it. And they took it in stride, and that's just the way it usually works. But if they don't get it, again, 3 days before closing, so let's draw it out in a timeline. Then it just means that you're not closing when you thought you were, which could be a big deal, right? If you were planning to close Friday, you scheduled movers for Friday, maybe you were renting in order to buy this thing, and so now you got to be out because your landlord's going to have you. They're not going to let you stay. It could be that your rate lock expires Friday, so if you're going to close on Tuesday instead, you need to have like another several days of rate lock extension. So yeah, it could be a big deal. But let's say here we have the borrower applying for the loan, which means the address is given. Property address is given. It's right here. So whatever date this is, 3 days after that, 3 days, within 3 days, that lender's got to give that borrower the loan estimate. And then fast forward to closing day. Let me do it this way because that's going to be deceiving. Closing. 3 days before closing, that lender needs to give the buyer the closing disclosure. So just know that and that. 3 days after 3 days after loan application, need to get a loan estimate. 3 days before closing, need to get the final CD. What do those things look like? Keeping on down the road here, sale price, and then it shows the loan amount in the major big block there in the middle. This is one page. This is all the first page right here. Hopefully you can just about see the whole first page on this display. The interest rate, what does that mean for your payment? What your payment is going to be? Prepayment penalty, is there one? Yes or no? Is there a balloon payment? And then it breaks down the payment in the next box. $761 toward principal and interest, another $82 toward your insurance every month, another $206 toward your taxes every month, for a total payment of $1,050. And in this case, I guess they have a payment for the first 7 years being a little different than the payment after that, because partly, what's different? I guess they don't allow for the insurance on those later years for some reason. And then they're just spelling out the closing costs. How much for the buyer's closing costs total? $8,000. Therefore, between the down payment and the closing costs together, Buyer needs to bring $16,054 to closing. This is what they're going to get within 3 days of their loan application. So fast forward to the closing. And it looks like this. Looks real similar, doesn't it? The only difference is the words closing disclosure at the top. Still got the loan term, still got the payment and all that fun stuff. If you see if there's another page. Oh yeah, okay, here we go. The other part of the closing disclosure shows all of the expenses on both sides. This entire page you don't have to worry about for our class here, but you will cover it in Post 302. We actually create one of these and plug and play. But I just want you to see what you're going to be dealing with in real life. They've got columns for the borrower and then another column for the seller. And this entire page is all about the expenses. Nothing is as a credit to anybody. All of this is what they need to pay out. We won't dive into this stuff, but this is part of that closing disclosure where every item is accounted for. And then this one is what I wanted to show you at the top. Back when that loan estimate was given, within 3 days of the loan application, they promised some things. The lender promised the borrower what things were going to cost. So at the loan estimate, here's what they said. Then they're going to compare to what it was actually on the closing disclosure. We're going to talk about 3 different categories of things the lender is responsible for or not. And if it's a fee that they charge, like the origination fee, and they promised it would be 1%, but it ended up being 1.5%, the lender has to pay for whatever over that they promised it would be. They've got to honor the number they promised if it's a fee that they charge and have control over. We'll talk more about that in a minute. But this is where they compare what they promised with what it ended up being so that borrower can see how close they got. Because in many cases, the lender has to absorb the overage. And then this is the other main section. This one, think of this in 4 blocks. We have this block up here, which is everything the borrower needs to pay. Again, we're not deep diving here. I'm just trying to give you a 30,000-foot view. The borrower's paying goes in this block. If I could mark this up, I would do it. The borrower is receiving money. Those monies will be reflected in this lower block. Then what is the seller receiving? That's in this upper block. And what's the seller having to pay is in this other final 4th block. So all that stuff, this page will have credits in it in addition to debits, to expenses as well as credits. I think that's all I really need to show you. The last page is just some definition stuff and some check boxes of what's a part of the whole thing, but it's not a lot of fill in the blank stuff. But just notice how similar both the loan estimate and the closing disclosure are. We're accounting for all the funds. What is our responsibility as a broker for this stuff? As a broker, we are responsible for anything that the contract says. So what about loan fees? No, we're not responsible for checking that loan fees are accurate on the closing disclosure because we have nothing to do with that. What we do have to do with are closing costs, purchase price, loan amount, all the contract related stuff. Oh, negotiations from repairs, things being fixed and paid for. They could, in the chat, when you say address is given, this assumes buyer's under contract. They could have a property address that they do a pre-approval for, a loan estimate for, without being under contract. Okay, RESPA. Let's look more closely at RESPA. Real Estate Settlement Procedures Act. That's what it stands for. RESPA. It was first created back in the 70s, 74. And the purpose is to protect consumers from abusive lending practices. Because lenders were, some lenders, everybody's got some bad apples, were doing some bad things. One thing might be that they promise a buyer a really low rate, but then at the week of closing, the lender actually has a different rate than the buyer was expecting. Or maybe the buyer didn't realize that cost them some points. And so they had some fees that popped up that they weren't told about. All that sort of stuff needed to be fixed. So that's what the purpose of RESPA is, so that buyers could get accurate estimates of what they're going to be charged at closing. And then over time, in the last several years, we got a little even more better about this disclosure, and the loan estimate versus the closing disclosure concept was created. RESPA is also in place to keep kickbacks from happening. If a broker gets paid by an inspector for referring that inspector, that's not the same thing as if a broker suggests that you have an inspection done by this inspector because they're so good, right? Knowing that a broker is suggesting someone because they're going to get a piece of money from it kind of takes away from your confidence in that person they're suggesting, because they're doing it for their own best interest and they've got to put you first. Therefore, purpose of RESPA is also to eliminate kickbacks between vendors and brokers. And then also, we talked about, let me see if how that lender could collect a couple of months for taxes and a few months for insurance, right? In order to set up the escrow account. So when those things come due, they have it to pay for. Let's take a look at that expense page from the closing disclosure. And here we go. In this case, the lender is asking the closing attorney to collect 2 months of homeowners insurance, and then also 2 months for property taxes. And what's going to happen is basically that's how much more the buyer needs to bring to closing. They need to bring an additional 201 plus 210 to closing, so that the lender can end up getting it, so that the lender can use it to establish the escrow account for the buyer. So that every month when they make their house payment, PITI, the T and the I goes into this escrow account along with this initial $400 and some, so that there's enough cushion to pay out those bills when they come due. Well, you better believe that if a lender could get away with it, if it weren't for a law restricting them from doing it, a lender, instead of saying just 2 months, they'd probably say 12 years. They'd probably want a whole bunch of money, because that's that much more money that they get, that they can now do what with? Loan out to more people, right? They could require more money from borrowers, but they can only require enough to accomplish the goal intended. They can't do it for their own best interest, and that's why that's why it says RESPA restricts excessive escrow account deposits. They can't just the lender can't just require a buyer to give them unlimited amounts of money to establish those escrow accounts. Under RESPA, there's another regulation called Regulation X. And Regulation X just says that RESPA is applying to certain types of property only. RESPA doesn't cover commercial property. The Real Estate Settlement Procedures Act is in place for residential property, but not all of it. Only the 1 to 4 unit properties, single family homes, condos, and townhomes. Anytime it's a 5 unit multifamily or more, it's considered commercial. So RESPA, Regulation X under RESPA, says this is for residential 1 to 4, single family, condos, and townhouses. All of those, when they close, must conform to RESPA guidelines. It also says that RESPA applies to properties that are financed with a federally related new loan. Federally related new loan. So let's think about what that means. When 2008 came along, a lot of craziness happened. Anybody familiar? Anybody read The Big Short and understand the mortgage crisis and how lenders were kind of abusing the process. The idea was, what's more stable than the real estate market? Not very much. People were overly confident in the real estate market. So over time, leading up to 2008, they would make things like stated income loans. Well, as a broker making 100% commission, we loved stated income loans. What's that? It means that you don't have to prove anything. You're going in there to that lender, and the lender says, hey, what do you want to buy? And you say, I want to buy this $450,000 house. And the lender says, well, you would need to make such and such in order to afford that. Do you make that? Yep. Sign here saying that you make it. Okay. It's basically like that. State your income. We're going to put the pressure on you, but stated income, basically that. There were also 125% loan to value ratios. Wait a minute. If a 90% loan to value ratio means 10% down payment and 100% loan to value ratio means no down payment, what does 125% loan to value ratio mean? That meant that buyers got the keys to the house and money in their pocket. The lender was so confident in the real estate market, they thought, well, surely this property is going to appreciate very soon. So let's go ahead and let them buy it, have the keys, and we'll go ahead and give them sort of an advance, and they can just have a chunk of money to, buy some blinds, maybe some furniture, whatever they want. 125% LTV. And then a lot that whole crisis had to do with was subprime mortgages. They were more and more confident that even people who had bad credit, challenged credit, would still make their house payment. If they got into tough times, the idea was surely nobody's going to stop making their mortgage payment. They'll let their house get repossessed. Their car get repossessed before they'd stop making their. Well, how wrong were they? How many people have seen a really nice car outside of a not as nice house? They keep that car going before they kept the house going. And then another big issue back then was adjustable rate mortgages. We still have those. There's nothing wrong with them. They serve a purpose, but people were doing it wrong. People who were trying to afford a certain level of house, the lender would say, well, don't worry. I know you can't afford it this year, but you said you might be getting a raise the end of the month or end of the year. How about we go ahead and do an adjustable rate mortgage where you get a lower rate this year, and then next year or maybe in 2 years, it adjusts depending on some sort of like a 10-year treasury bond or something. So it might go up, but it might go down. But right now it's going to be lower than what the average is. Therefore, you can afford it. The sad part was they were buying too close to the top of their ability already. Plus, it was an adjustable rate, and the amount that it adjusted up to was out of their ability to maintain. And so a couple little sideways things happen in life, a couple things just go wrong, and they can't afford that payment anymore. Another thing we saw back then were, I think I mentioned before, something called a pick a pay program, where you would get your statement from your lender and it would say you can pay $1,550 for your full loan amount, or your full mortgage payment, includes principal and interest. Or you can choose to pay the interest only option, which is just $1,200. The problem with that is you're not making any progress. You're basically just renting. You're only paying the lender their interest. You're not knocking down your loan amount. Therefore, people got addicted to that $1,200 instead of the $1,550, and they just kept doing it and made no progress. And all the while, values were dropping. So they were not lowering their loan obligation amount along with the values dropping, and so they ended up being upside down. When you're upside down in your house, that means not yoga. It means you owe more than you can get for it, right? Which leads to the short sale possibility as being something that people would utilize. There we go. That's better. Okay, so that's 2008, 9, 10. Well, something was passed through legislation called the Dodd-Frank Act. You might have seen that in the book. Dodd-Frank Act put a lot of things in place to keep that predatory stuff from becoming a problem again, to help fix the big mess we were in. The Dodd-Frank Act. And then they also revised the RESPA policy. But up until then, we used a good faith estimate. The lender would tell the borrower, here's what your fees are going to be. Here's a good faith estimate. But it had no requirement of disclosure. It needed to be in there, but it could be anywhere. In the fine print, buried on page 37. They adopted the loan estimate versus closing disclosure looking the same. You can see the same stuff in the same place and compare different loans from different lenders much more easily. And then also the government said, okay, guys, you screwed up. You lenders, you screwed up across the board. So we're going to step in. We, the government, are going to kind of oversee everything from now on. Make sure you conform and comply as you're supposed to. The government started overseeing not just government loans like FHA, VA, but also conventional loans. They sort of just stepped in and said, we need to just make sure this doesn't happen again. So all of that said, for this last sentence on this slide, what is a federally related loan? Everything. Not just FHA, VA, but because there's government oversight, basically every loan, even conventional loans, are considered a federally related loan when it comes to RESPA and having to follow RESPA guidelines. So anything financed, you could pretty much end it there. Anything financed that's residential under Regulation X needs to comply with RESPA rules. What is the lender's responsibility? Well, we've already kind of given you the spoiler on that loan estimate. Also, the lender needs to give the borrower something called your home loan toolkit. It's a PDF, it's a document, either way. Just basically says if you don't pay, you don't stay. Here's how loans work. Keep making your payment and you'll be fine. So that's what the lender is required to do. And the lender's basically just giving a disclosure to that buyer. They're saying, here's what we charge. Here's what you're going to have to pay if you use the loan and go with us. And here's what we already covered too. This falls under something that I just always laugh at. It's like the ultimate acronym. We do a lot of acronyms in this business. And so you might see this referred in your book. This acronym TRID, T-R-I-D. What TRID stands for is Truth in Lending, right? Remember the Truth in Lending Act? Basically tell the truth in your lending practices. Truth in Lending, RESPA, that's the R, Information, Disclosure. So it's an acronym with two acronyms in it. It's a big monster acronym. It means Truth in Lending, Real Estate Settlement Procedures Act, Information Disclosure. It ties it all in together. It makes sure that everything is disclosed. And it's also the thing that says that loan estimate must be given to the borrower no later than 3 days after they make loan application. And that the closing disclosure is given to the borrower no later than 3 days before the settlement date. Back to the loan estimate and the closing disclosure. There are some tolerance requirements given. That lender has to, let me do it a different way. It might look a little better this way. The lender's required to disclose certain expenses to the point where some of them they're going to have to stand behind and absorb if they get it wrong. So there are 3 categories. There's a zero tolerance category. Oops, I'll show it to you in a minute. I'm working on it. Here we go. There's a zero tolerance category that the lender is responsible for all of. If the lender promises certain items that fall under this category, if they are off by a penny, they've got to absorb it. If they're off by 100 or 1,000, they've got to eat it. The borrower knows for a fact that anything under the zero tolerance category is going to be exactly what they're paying fast forward at closing. What they see on the loan estimate is going to be exactly what they'll see on the closing disclosure. And if it's not, they don't have to worry about it because the lender is by law required to pay it if it exceeds what they promised. But that's just for this first category called zero tolerance. There's another category. Oh, the zero tolerance category is things that the lender has full control over. Like on my side, I can tell you what I charge as a broker. It's that sort of thing. For the lender, they can tell you what they charge for loan origination or a handful of other things that is what they charge. They've got to stand behind that. If they choose to increase that between loan estimate and closing disclosure, that's not your problem. They're going to have to eat it. Then there's stuff that the lender might pick from a list that the borrower can choose. The lender says, hey, borrower, we need you to pick from this list of 3 potential vendors. Which one do you want? Because the lender gave them the choices, then the lender is held to a 10% cap. In other words, if that item exceeds 10% over what they were promised it would cost, then the lender has to eat it. But it can exceed up to 10% more than promised, and the lender doesn't have to absorb it. The borrower would still have to pay more, but anything more than 10% over, the lender's going to have to cover. And then there's some things that the borrower is going to choose, things like a home inspector. The lender has nothing to do with a home inspection. The lender doesn't make any suggestions on who you should pick for your home inspection or your survey or your appraisal. So certain things that are within the full realm of the buyer's choice, then the lender is not expected to have to cover at all. So the buyer, that's the no limit category. Whatever the buyer picks is on them. It's not the lender's responsibility to pay for that at all. So that could be something different on the LE versus the CD. Let's look at it. That loan estimate again. Let's see if I have it here. Nope, it's going to be on the closing disclosure. Yeah. So first of all, now let's look at this one. The items that the lender has to stand behind, here's the 3 categories. This first A block has the origination fee, the application fee, and the underwriting fee. All of these are things the lender has full control over what they charge. This is the entire zero tolerance category. Anything that falls under that is going to be listed in this block on the closing disclosure. Then the services that the borrower did not shop for, these are the 10% tolerance things. None of these things should go more than 10% over what they were promised. If they do, the lender has to absorb it. But if they go 10% or less over promised, the buyer has to pay for. And then the stuff that the borrower did shop for, this is the section where that's just on the borrower. The lender has nothing to do with. The borrower chose to pick these things. And so the lender has no responsibility there. Oh, sorry. Just realized I wasn't showing you that. Sorry, guys. You got to stay on top of things. I'm doing you wrong. Okay, let's look at it one more time. Here it is. This A block, that's the zero tolerance block. Loan related fees the lender has full control over. The B block, the 10% tolerance block, and then the C block here is the no limit. Whatever the borrower chooses is their responsibility to pay. The lender's not held to a responsibility for these items. Sorry about that. Okay. A couple other things that RESPA does. They regulate controlled business arrangements. We don't need to worry about that too much. They control borrower credit for yield spread premium. What the heck does that mean? Lenders make money on the front end as well as the back end. They make money from the borrower paying things, but they also make money when they sell the loan to other lenders. And so that loan originator you're working with might make some money up front, but also later. Well, the RESPA regulates how much can be charged for certain things, and that's kind of what they're talking about with borrower credit for yield spread premiums. Escrow account restrictions, we've talked about that. Loan servicing disclosures, meaning if you're going to sell the loan or let another person, another entity service the loan or collect payment for the loan, you just have to tell the borrower who it is that they're making their payment to. We as real estate brokers have a responsibility under RESPA. It oversees us and just says, hey, brokers, you can't get a kickback. We're not allowed to get kickbacks or referral fees for settlement services, inspections, appraisals, attorneys, surveys, any of that stuff, not allowed to get, and that includes anything of value. Don't let that inspector give you Panther tickets or Hornet tickets. All of those are things of value. So that's the main RESPA requirement for brokers, real estate brokers. Can't get kickbacks. We've talked about this a couple of times already. Our obligation for closing disclosure under RESPA is that we make sure things are done right. Right? The things that came from the contract, the price, confirm the accuracy. So we're not like calculating these things here. Sorry, we're not the ones making this disclosure and filling in all these blocks with numbers. The paralegal does that. The attorney makes sure, but we need to look at this thing and make sure that things pertaining to our client from the contract are correct. This first block about the loan fees, that's not on us, but even the appraisal fee, not in the credit report, no, but mostly the things on the other page we are responsible for, like the price, like the closing costs if the seller's paying toward the buyer, taxes. We need to make sure those were calculated properly, and I've caught mistakes on these things before. Credits, like a seller credit, make sure it's attributed to the right place. If they just flip it over here, then it's going to be completely going to the wrong person. And then there's taxes again. So that's what we're responsible for, making sure that stuff that came from the contract that we had something to do with, for instance, is figured and calculated right. Due diligence, earnest money, warranty, commission amounts, of course, that's really the first thing you check. Make sure you're getting paid. Credits, invoices. The attorney will ask you, hey, broker, send us any invoices that need to be paid at closing. What happens if you violate RESPA? Like, for instance, what happens if you take that kickback and you get busted? Pretty serious, sort of like the loan fraud, but not quite as much. $10,000 per violation. Did you take a kickback from an inspector plus a surveyor plus the closing attorney? Well, there's 3 violations. There's 30 grand. Up to a year imprisonment, paying back the victim, and because it's a RESPA violation and you get sued and you lose the lawsuit 3 times, triple the damages because it's RESPA. There's another thing in our industry that can cause us to triple the damages if we're determined guilty, and that's fair housing violations. So both RESPA and fair housing can triple or treble. You might see the word treble the damages, 3 times it, 3x. That settlement statement is prepared by the paralegals. They basically have it's like an Excel, a specialized Excel document, and they plug into the right spaces all these various numbers, and then we need to double check. But we also need to talk about this stuff with our seller in advance, back when we list it. So we need to show them what their proposed net is going to be. Well, anybody take an accounting course? Anybody take a college level accounting course? Well, think of debits and credits not that way. The way they look at it's a little different. Just think of the debits and credits in a closing disclosure as your checking account. When you swipe that debit card, money is coming out of your checking account. When you put money in, maybe you have a direct deposit from your work, money's going into your that's a credit, right? A debit versus a credit. So a charge. So when we're debiting the buyer, we're charging the buyer something. We're debiting the seller, it's a charge to the seller. Credit to the seller is money going into or to the seller. Sometimes we need to take money from one side and give that same amount of money to the other side. And that's called a proration. A proration is a thing where you're taking, let's say, $301.23 from the seller, and you're debiting the seller for that, and you're crediting the buyer for $301.23. So it's going to be the exact same dollar amount, and it's going to be a debit from one and a credit to the other. That's what's called a proration. And there are a couple things that we do prorations on related to a closing, because we might need to make it fair between buyer and seller because the taxes are due, right? Property taxes, homeowner dues, rent. If it's an investment property, the seller collected the rent on the first day, but then they closed on it, sold the property on the 13th of the month. They have an entire month's worth of rent. They need to give back the amount of rent that equals the 14th of the month through the end. That buyer's the one who should get that rent because they're the one who's going to be the owner for the rest of that month and then forever, or however long they own it. We're just worried about that one just for the month, though. So that's what a proration is. So we're going to be doing some math involving prorations, splitting fees between the parties, depending on the time they owned it, how much time the seller has owned it versus the buyer. When it comes to prorating taxes, we're going to do that a couple of ways. But one way is if we have a closing anytime before September 1st. What is special about September 1st? You can't pay your taxes until then. So the way we handle property taxes when we have a closing before September 1st is we debit the seller January 1st through the day of closing, and we give that chunk of money to the buyer. Debit the seller, credit the buyer for that amount of money, whatever the day of closing is. We'll do that together. But that would be a proration. A couple other words to know. The word accrued means the money is due but not yet paid. Accrued means due but not yet paid. Prepaid means it's going to be paid in advance. Another word I could add to this slide is arrears that I mentioned an hour ago. That's how we make mortgage payments. You pay your rent in advance. You make your mortgage payment in arrears. You pay after you stay when you own it. You pay before you stay there when you rent it. Some examples of buyer fees include these things. So between now and next week, definitely work your way through this stuff. Get into that math, start working with that, and get nice and confused. That's good, because then when we clear it up, it'll stick in your memory a lot easier. But what you're going to need to know that's testable is, what is the buyer typically responsible for paying? What are some typical buyer closing costs? All of these things. Loan related, anything loan related, attorney fees, survey fees. And then compare this list of what was that, about 8 or 10 or 12 things, to this list for the seller fees. There's fewer line items on the seller's fees, but it might be more in dollar amount, right? Because commission might add up pretty much. Of course, the buyer's ultimate fee is going to be the purchase price. That's a pretty big one. But the seller fees on the closing disclosure, commission, excise tax, deed preparation is really about the only attorney fee that the seller is responsible for. And with that, I'm going to call it. Have a great weekend. If you got Christmas parties, holiday parties, hope you have wonderful time, and I'll see you next Wednesday. You let me know if you have any questions along the way. Put your name in the chat for me. You're welcome. See you next week. You're welcome. Take care.